Ladies and gentlemen, that lunch, that elaborate lunch kind of makes it difficult here, but don't worry. We have you covered because we have a power-packed agenda. So let's take it from the top once again. Good afternoon, everyone. Thank you. How are you doing this afternoon? Very well. Good. Almost there. Well, these are actually the answers I'm looking for, because our job really on this stage is to take you from there to feeling absolutely phenomenal by the end of this evening. My name is Xenia Fernandez, and what a pleasure it is to be standing here and welcoming all of you to the 8th edition of the Mint India Investment Summit, presented by JSA Advocates and Solicitors. And that is your cue for a round of applause, everybody. Come on. You can make it slightly louder. Help me out here. I just need everyone to know that we're getting started. Thank you. Thank you so much. Now, I can see a lot of familiar faces for someone who's been standing on the stage of this investment summit for a couple of years now. I can also see a lot of you who are bringing in that breath of fresh air. Whether you are in this room for the first time or the 8th time, I can assure you that this is really the arena where policy meets capital, where insight meets action, and where legacy meets a certain disruption, but with ease and positivity. Today, we're not just here to talk about numbers. We're here to talk about the vision. India, $10 trillion by 2032. It is a vision that is inked with growth, with resilience, and of course, with capital. But you'll agree with me when I say that this is not just going to be a straight highway. It is, in fact, like those winding ghats with absolutely unexpected curves. Talk about geopolitical speed breakers, talk about global market detours, and also that famous K-shaped curve that always is testing our shock absorbers. Metros, well, they're bursting at the seams. Tier 2s are firing up their engines, and if you ask me, the gig economy is sort of becoming the brand new unicorn. In the middle of all of this, the question really is, can our capital meet our conviction? The India 2040 that we envision, can we get there by beating inflation, geopolitics, and of course the talent gaps that keep pulling us back? We're going to answer all of these questions and many more. So usually as a host, I come on stage and I say, sit back, relax, and enjoy the show. But I won't say that, because when I look at this agenda, I want to say, unfasten those seat belts, come to the edge of your seats, and let's make the most of this. And in fact, to make that happen, I want to introduce all of you to the intro bot. So at Mint India Investment Summit and Awards, we're just making things a little more interesting, making it easier for all of us to have conversations off the stage as well. All of you, when you registered earlier today, you would have received a WhatsApp message from Mint India Investment Summit with a QR code. Please use that QR code. In fact, right under there, you'll see something that says Join Now. When you click on Join Now, voila, you are, rather let me put it this way, the gates of networking open, all right? You get to choose by category the kind of people you'd like to have a conversation with offline. So please make the most of it. In case, just in case, you can't get your hands on that WhatsApp message or that QR code, I believe we have a QR code on the 10 cards at each and every table. You can scan that right away, and please make use of the strategic breaks we have to find like-minded people. Now, before we go any further, ladies and gentlemen, I want to take this moment to thank our partners who make events like these possible. Our presenting partner, JSA Advocates and Solicitors, Real Estate Partner, JLL, Associate Partners, GM Financials, Equiris Wealth, Bajaj Finserv Asset Management Company. Can we have a round of applause for our partners, please? Thank you. Thank you so much. Okay, so you know, if India were a stock, it would be buy on dips and possibly hold for life. And if you were looking for someone who's done just that, time and again, you couldn't find a sharper mind than our first speaker of the day. Warburg Pincus is not really here for just the India is hot headlines. They're the folks who actually saw the sizzle, long before the sun rose. And as the world's largest pool of capital are moving eastwards, really, the India pitch, which is not just about size, it's about scale. But this is scale with soul, with growth, with a certain amount of resilience, and of course, a risk with returns. So how are global funds reading tea leaves in 2025? What are the signals that are blinking green, and what are those that are flashing amber? To tell us all of this and to unpack the India playbook, let's welcome Vishal Mahadevia, Managing Director and Head of Asia Private Equity, Warburg Pincus, who will be joined in conversation with Mint's Editor-in-Chief, Ravi Krishna. And everybody, huge round of applause for our first speaker at the Mint India Investment Summit. Welcome. Welcome, gentlemen.
Hi, welcome everyone. We could not have started with a better speaker than Vishal to kick off proceedings. So let me start with a question that is uppermost on everyone's minds, and which I think is going to be a recurring question that will be asked of most speakers, which is how do you view the changes which are happening in the US, what President Donald Trump is saying about tariffs, the impending trade wars? How is it going to impact your business?
So firstly, thank you, Ravi. Thank you to Mint for inviting me to be back here. It's great to be back and to see so many familiar and friendly faces in the room. Thank you for starting with such an easy question. I mean, really, Donald Trump, US tariffs, it feels a different answer and a different issue every day. I'm not a geopolitical expert. I'm not a political scientist. There will be other people who will come and talk to you about that. But it does feel like the world is an even more uncertain place. And that uncertainty continues to increase day by day. That volatility continues to increase day by day, week by week. And when you look at the US, I would actually go back and say, interestingly, keep the last 2 years out. It's been decades where there's been a wave of globalization. The US built the system, right? The World Health Organization, the WTO, take your pick, NATO, everything else. And that world order seems to be shaking a bit. And as you talk about tariffs and you talk about economy and you talk about economics, that volatility as investors, all of us, that's why we're here. We're all investors as we think of ourselves as equity investors. That just increases the risk. And when you increase risk and you increase risk premia, it means reward has to be greater to compensate for that risk. And therefore, there's an impact on valuation. And I think we're seeing that. We're living it day to day in the stock markets and in the general equity markets as well.
But does this open any areas of opportunities for private equity to exploit?
So let me talk global for a second, because that's really the theme here, and then come to India and how that impacts all of us. I think there's never been a more interesting time, and I'll talk from an India perspective, to be a private equity investor. As I look at it globally, our industry, and again, I will talk about private capital here, and then we can come to public markets. I think there's tremendous opportunities. Our business as equity investors and as private equity investors is really more interesting and potentially more rewarding when there's periods of disruption. If everything's going great, how do I generate better returns than the next person? The tide is rising, everyone's doing great. Don't get me wrong, I love it. We make great returns, everyone makes great returns. But it's in period of disruptions where you can actually stand out. You can deliver differentiated returns, deliver alpha to your investors. It's more complicated, requires more work, and definitely requires some real guts, if I have to say, and resilience to live through periods of volatility. But I actually think it's a really interesting time. In the world, the theme for the last few years has been US exceptionalism. In the last 20 years, if all you did was invest in the US and nowhere else, you made more money than anyone else. Diversification did not pay. Asia did not pay, Europe did not pay. US continued to perform really, really well. Best performing market. That's being questioned in the past few months now for the first time. Other than the US, where are people looking to invest in the world? India and Japan. I promise you, if you talk to most investors, that's sort of the view. Europe, everyone's worried about certain things. China, less said the better when you talk about the broad investor sentiment. So overall, when you talk about the shift from US exceptionalism, what happens? There is an opportunity, both for India and for other spots in the world.
If you were to, so it is a period of uncertainty, as you said. If you were to compare it with the last time when you know, we were looking at something like this, that would be the global financial crisis. How is this time different from, 2008?
So I was telling you a little story earlier about 2008. I remember Warburg Pincus had an offsite. These things get planned, as many of you know, in your organizations, well in advance. This offsite happened to be in October 2008. I remember it was the most depressing offsite ever. Lehman Brothers was exploding. You don't even know if the world and financial markets would exist by the time you got back home. It was probably, I would say, as uncertain or most unsettling a time. But it actually, there was a path to solving it. The central banks got together, there was global coordination, reflated the economy, and you actually had a path back to where things got stable pretty quickly. This time, it feels just there's so much geopolitical uncertainty versus economic uncertainty. With economic uncertainty, some of these coordinated efforts can be achieved. Geopolitical uncertainty and different me first as a country shift away from globalization, that feels like this period of uncertainty could last longer. That would be my, if I compare it to what was happening in the global financial crisis to today, I think investors will need to be more patient to live through this period of uncertainty longer.
So how do you think it will impact deal making?
Sorry,
how will it impact deal making? I mean, what are the variables that you will consider which would change from the normal course?
Yeah, so it's a great question. Look, when it gets very uncertain, deal making is tough because nobody wants to do a deal. Both sellers and buyers can't figure out what's going on. On the flip side, our pipeline in India, in Asia, even globally, is pretty robust. We don't see a dearth of deals that are out there in the private equity space. Large mergers and acquisitions, I'm keeping out of private equity, just broadly when you look at it globally, it becomes just harder to execute with greater uncertainty out there between sellers and buyers. But in a period of uncertainty, as I said, it also creates opportunity. Some companies don't have the capital. Some folks who have already lived through a difficult time say, okay, I don't want to live through the next 5 years. I'm not sure I have that kind of capacity. I want to sell my business. I want to find the next partner. Let me find a private equity investor to come in and do something like that. So it's different types of deals, different reasons they're coming in there. But deal making is very much happening. And I think when you look at it, like I said, in India, in Asia in particular, I think our pipeline is as robust as I've seen it.
I mean, given the way that things are going, do you expect to more of your bandwidth to be absorbed in managing the government or regulators?
No, I don't. Look, my bandwidth, so let me tell you, managing government and regulators has never been something that I have been very focused on. They do a job, they do a great job, they have a job that I will never understand. I've never been in government, I've never been a regulator. So I give kudos to them. Our companies, our management teams, the entrepreneurs we work with, they work with government, they work with regulators in their business. We support them as investors. So I would say less an issue for me. Within each country, and if you're asking a particular question about a country, but if you look at it globally, people need to be more aware of it. So, of course, at Warburg Pincus and at every large private equity fund, you would have a large government relations unit that would be thinking about policy, thinking about where it's going, thinking about the impact of some of these changes and macro and understanding it. And that's very important. If you are a global investor and you don't have that, and you don't have that knowledge and that connectivity, you're not going to be a very good investor.
Going back to what you were saying about US exceptionalism, Is that era over? Is that what you're saying?
No, I'm not saying it's over. I think it's being questioned right now for the first time, which creates an opening as investors think about where else should I deploy my capital. 6 months ago, if you asked someone where we should deploy our capital, the first answer would be the US. And then, yeah, maybe a little bit in India, maybe somewhere in Japan, things like that. But today, if you ask the question, people will have to question themselves, how much exposure do I have to the US, and do I want to keep increasing it, or should I be thinking of other places to invest? That creates an opportunity for other countries. It creates an opportunity for India. But I'll borrow a line from our former CEO, now Chairman Chip Kay, who knows India better than me, better than most people who I know. Opportunity and potential does not mean destiny. So India has a lot of work to do to achieve that, but that opportunity is there.
So, I mean, what makes the case for India? I mean, when we were having a conversation, you said this is a great time to be here. Japan also you mentioned.
Yeah.
So,
very different cases. So, audience is probably more interested in India, but let me give you a little case for Japan, which is very different. It's a country which has, I'll just contrast it, why there's an opportunity and why it can be different for private equity. What is happening in Japan? There's no growth. Everyone knows demographics are in decline. That's not a growth economy. But it's been a very closed economy in terms of its governance, the way companies have done, I would say not run the most efficiently. As those norms start getting unshackled and as companies start to come under pressure from activists in the public market, from places saying, we want you to use your capital better, it starts to create opportunities for them to say, hey, I have to sell this non-core asset, or I have an opportunity to take this company private, improve my operating efficiencies, do what I'm doing. And that creates an opportunity for private equity to come in and help those companies do it. Very different from India. India really, I mean, it's got so many things going for it. I don't need to go through this audience on the macro stuff. I think you got Neil later. He'll talk all about it. He might be more negative. He's always a little bit of the other side. But if you look at it longer term, which other economy has an opportunity to become a $10 trillion economy in the world? Name one. Again, as I said, it's not destiny. India's got the best opportunity to get there. As you think about it with a global lens, and as you look at economies that can reach that scale, that's probably the best opportunity when you look at India. Many reasons you can say entrepreneurship is here. We're starting from a low base. So there's a multi-decade-long growth tailwind that you can hit if you get things right. Not there in many other parts of the world. If you're an investor investing around the globe, those are things that are tough to find. And those are ingredients that India has.
so there was a caveat I noticed. If you get things right, what are the things that need to be, righted?
Oh, I'm not, I would say it would be wrong for me to advise what we need to get right. What we have gotten, I'll go from experience. What we've got wrong in the past is many things. So India has always had this potential to be a $10 trillion economy, $5 trillion economy. But we've in the past had a habit of scoring what we like to call self-goals, whether it's regulation, whether it's government policy, whether it's industry, right? Including capital, behaving in too rash a fashion, rushing in. In the end, all constituents, I think, have a part to play responsibly in order to make sure India reaches its $10 trillion potential. I can't point to anything that I would say is a problem. I mean, there's many things people will have complaints about. Government regulators are open to listening. Industry bodies are participating. Entrepreneurs are waiting to unleash the next level. Capital, I can tell you honestly, capital is waiting to flood into India if those opportunities are there. So it feels the ingredients are there. My caveat is only that India has always managed to score that self-goal. Let's not score it this time.
Yeah, you're saying capital is waiting to come in, but I mean, you look at net FDI that has been coming down for the last 3-4 years. FPIs are fleeing the country. Of course, that might be a temporary kind of a reason. So while we all know that the potential is there, to bridge that last mile gap and actually translate it into reality, that still seems to be missing because we are nowhere near that 8% growth which people have been talking about.
Yeah, I won't talk macro growth, but I will talk about capital from the private side. So FIIs, everyone's seen it in the press. FIIs have been selling. If you talk to any FII around the world, will they tell you we don't like India? That's why we're selling. No. They'll say, look, valuations seem high. We've made a lot of money in India. We want to book that profit and we want to invest in 6 months ago US because US is delivering great returns, right? So I would say when you talk to most global investors and the folks we talk to are investors in our funds, all of them, 10 out of 10 are interested in India. I won't say 10 out of 10 invest in India because there's always some story of some friend, someone who's had a tough experience in India, or wait a second, I'm making a lot of money in the US. Why would I go and invest it in a place like India? I visited there once, I don't know it as well, I'm making 20% returns in the US. So there's a bit of that has played into the talk. I would say the capital's waiting to come in. It's the opportunities that need to present itself.
This ongoing correction in public markets,
Yeah.
I mean, you think it's going to drive more deals? Because valuations are now kind of, getting to reasonable levels.
I would say, talking from the private market standpoint, what has happened in private equity, in the large private equity players in a large extent, the market has shifted a lot to growth buyouts, where you're actually taking control positions, buyout positions in these companies. It's providing us scale, and it's providing us the opportunity to then really drive business more than we would, as you would say, as a minority growth investor. We're doing both as private equity players. Having said that, that part of the market and that opportunity, I don't think slowed down last year when valuations were higher in the market. And I don't think they've gone in a different direction just because the market's down. The public markets up and down will affect sentiment. So yes, valuations of the private market may come down a little bit. But I think for us, when I think about it, that temporary 10% up or down, when you're doing a growth buyout and thinking about a company and what we can do with it in a 5-7 year period, I don't think that's the difference between deal making and not for us. Just to share some numbers, as an industry, and I know you're throwing out some net FDI numbers, but as an industry investing private capital in the country, that has only accelerated every year for the last 5 years, private equity investments. Other than, I would say, in 2021, when tech investments shot up, if you take that out, it's just accelerated consistently.
What about exit? Do exit strategies need to be tweaked? Because last year was good for IPOs, but this year seems to have gotten off to a slower start.
Yeah, I think, exit strategies, I don't think they need to be tweaked. We always have to have optionality on exit strategies. But today, it's tougher to, in a down market, to have exits in the public market. So you have to look at sponsor-to-sponsor exits. You have to find a strategic buyer if it's a controlled position. If it's a minority position, you have to be more creative and find other ways to basically monetize it. But I don't think tweaked as much. It's just a matter of the cycle. We've seen cycles when you have more public market exits, and you have cycles when you have more private market exits, and you're probably going into a little bit of that cycle this year.
Coming to China, I mean, now that you're head of Asia, you're looking at the whole region, Warburg seems to have been fairly bullish in China. In 2023, you had raised a local fund, etc. What do you think of this whole China plus one thesis, which has been playing out, for the last 4-5 years, where India is supposed to benefit, etc.? How do you view that whole thing? Is that a valid investment thesis now?
I am not a big subscriber to China plus one, to be honest. I think India can do manufacturing and be a manufacturing hub for India. That's the first place we should look at going. I think India does terrific in replacing and being a leader, regardless of the China mess, competing against China and global supply chains where there is high engineering value in a component, many SKUs, short production runs, all of those things. We invested in a company called Alliance Tire, feels like eons ago, which did exactly that. And they are able to produce product much cheaper than the Chinese competitors, and they could basically sell in the global markets and win. So I think India will continue and should do that. It's less a China plus one, and I haven't necessarily seen that playing out either in the last few years as we've done that.
But manufacturing as a percentage of GDP has come down for India. When I look at the macro numbers, examples like which you just quoted now, they are far and few between.
I think it'll take time. Like I said, it's not a thesis I have for China plus one. India manufacturing, I don't think there's a choice. India manufacturing has to start to increase. It's the right measure by the government to push it. And it has to start to increase for India to succeed and become that $10 trillion economy. Very few have reached that stage just by being services economies on domestic consumption to start with. Everyone's had a manufacturing base. And I think I'm seeing it happening slowly, part by part. These things, look, if you want to compare it to China, and I was just there a couple of weeks ago, they've built up that manufacturing expertise and base over decades. To think that we can do that in 2 years just because we have a China plus one policy, I think that's probably simplifying things. But let's start and then build it over the next however many years.
Yes. Questions from the audience? A couple of them. Anyone has a question? Yeah, Sneha.
Hi, Sneha from Mint. Vishal, wanted to understand how far are we from seeing global investors raising a dedicated, India dedicated fund? Are those pools of capital ever going to get raised?
Global investors raising India dedicated pools of capital, I would
Yes.
say is probably still further away in any scale. In any scale would be my answer. I think global investors who invest in private equity funds typically feel some degree of comfort with their investor base that says we want to invest in a broad regional play and allow you to allocate within Asia. Think about an investor sitting in the US that's saying, okay, I view Asia as part of my investment and I want you to figure out at what point in time do you want to invest money in Japan and India, China, Southeast Asia. So that's why you've seen most of the vehicles being raised by global investors, being Asia and regional funds. Having said that, there is a clear demand, and I see many of my colleagues out here, to raise India-dedicated funds. It's just not the global funds that would raise it, but there will be global investors interested in India-dedicated funds, and many of them and we have examples of them, as everyone's aware, of having been raised larger and larger funds, and I think that will continue to be successful.
Yeah, that gentleman.
This is Prashant Fernandez. And earlier you spoke about China. And looking at the China story, I think that has like kind of just taken off, in a way which is like phenomenal. It's almost a 30 trillion economy now. So do you think that's like a once in a kind of generation story, or do you think other countries can still replicate that kind of a growth? And what do you think led to this kind of a growth?
That's a very long, that could be a very long answer, so I'll try to keep it very short because there are a few questions in there. A lot of things led to it. I think it was just a tremendous opening of the economy, a push to drive manufacturing, and I'll give you one example. Local governments and officials had KPIs, and one of the KPIs was how much FDI you drove into your local economy, grounds up. So it was an investment-driven, manufacturing-driven surge that happened over multi-decades. I don't know that anyone will or needs to replicate that. And I'll come to India. I don't think India needs to replicate that. We will chart our own course. But we can succeed in our own way because we have our own strengths as a nation, as an economy, whether it's as we've got China today struggling, they're trying to drive consumption and more internal consumption in their economy. And that's a tough thing to do. That's something India has done. We are a consumption and service-driven economy. We're trying to drive now more manufacturing. So I think it'll happen very differently. I'm very positive. I'm here. I flew down to be part of the Mint Summit. Thank you for inviting me, as I said. But I'm excited. I'm telling you, as a private equity investor, I've been doing this for 30 years now. 20 years I've been here in India. I can't tell you of a time when I've seen investment opportunities and a pipeline for things that we're doing that are as compelling, as interesting at scale, as I see today in India. How our economy goes over the next, again, like I'm not an economist, but I think we'll chart our own course. And I don't think we need to become like China. I do think we have a good shot. And if I'm a betting person, and I am a little bit because I'm investing here, yeah, I do think India will become a 10 trillion economy sooner rather than later.
One final question. Yes.
Hi, Vishal. Thanks for those thoughts. Just picking some clues from your passing comments. As you mentioned about, there's a lot of uncertainty around, and a lot of uncertainties, like multiple of them. We at India are still at the bottom of the S curve that we are looking at, and we are trying to pick up. So in this scenario where there's so much of polycrisis that we are looking at, how do you really come to a solution? I'm Pankaj Jain from Pro Growth Ventures. We are also on the private equity side. So defining a solution. So when you look at a solution, when there were so many connected multi-crises going on, how do you really look at those strategies to be built up and still be relevant?
So just so I understood the question is, given that a solution is hard for all these global political crises and issues, how do you deal with it as private equity?
Because there is so much of polycrisis going on, there are so many crises across, how do you define strategies for your investments or to it which are connected and stay relevant?
Sure. Look, let me jump in. We can get stuck in the macro a lot. And it's important, thinking about all the crises, how it happens, where it's tariff. So let me pick I think the best way to answer the question is an example. We invested in a company in India, a little over a year ago, called WaterTech. Donald Trump can do tariffs here, he can do X, Y, etc. People still need to get plumbing in their homes. Okay? This is India for India. You're manufacturing in India. Yes, you think about all the global crises. What are my challenges out there? I'm not even worried about what Donald Trump is doing. I'm worried about how is management? Are they sorting it out? It's an execution issue. How are we opening in new markets? Is the return on investment on those new branches working out as it is? I am deeply micro on that one. And the market is so big out here, and the opportunity is so large, that if we get execution right, we will do very well on this investment. And so my focus is really around those questions. Sorry, but to answer your question as a strategy, yeah, today if you say, Vishal, there's an opportunity to invest in an auto component company that exports to the US primarily, I will likely say, look, that's not a deal that I can figure out a way to do today because the uncertainty is so high. That would be my answer as I think of a strategy. A company that's India for India, or China for China, right? Or Japan, where there's an improvement opportunity in improving the efficiency and increasing the EBITDA and getting your company to be better. Those are the strategies that, frankly, are easier to invest in at this time versus something linked to globalization, which is a bit more worrisome. And the last question, of course, look, there's going to be a slowdown. Tariffs are not good. They're taxes. Okay, that means higher inflation, rates higher for a while, potential recession. These are all things you have to build into your base case when you do your investment strategies.
Before winding up, if there is one theme that you would bet on for India over the next decade, what would it be, if you were to define it?
For India?
For India, yes.
That's easy. For me, and I'm biased, I've always loved financial services in India. I think it's probably the one sector which has been beaten down, and when everyone talks about Indian public markets are so expensive, it's probably the one that still trades below its long-term averages. I think it's a large market. If India does well, if you believe India is going to do well, and I think many of us in this room do, over a medium to long-term period, there is no way that Indian banks, Indian insurance companies, Indian financial services providers that are well-run, that execute well with good management, cannot do well. The two are not congruent for one to do well without the other. So that would be my theme.
So overall, can we say safely that India is no longer an emerging market? It is beyond that stage now?
I've been here for 20 years, so I think that as a private equity destination, I will talk from my perspective, India is the core of what we do at Warburg Pincus. It's always been our DNA. And it's just terrific to see other investors around the world now look at India and say, this is a core part of our strategy. It's not a, oh, by the by, let's think about it.
Well, thank you, Vishal, for your time.
Thank you.
Ladies and gentlemen, Vishal Mahadevia.
Thank you so much, Vishal. Ravi, I'd like to request you to kindly present a token of our gratitude to Vishal Mahadevia, and thank you for asking the most pertinent questions. Ravi, may I request you to please come center stage? Ladies and gentlemen, let's have a thunderous round of applause for our very first speaker and what I'd like to call an absolutely power-packed opening to the 8th Mint India Investment Summit. Thank you so much, gentlemen. Thank you very much. Well, India's stated target, which is $30 trillion GDP size and a per capita income of $18,000 by 2047, which is precisely when we complete 100 years of being a nation that is both modern and independent, is an objective that needs to be achieved. But this is really an India that needs to be more equitable as far as opportunities are concerned. Indians from both rural and urban areas must have the opportunity to earn these kind of incomes that are far higher than today. This is going to need a series of actions in practicality and in every sphere, from skilling to infrastructure. There is specifically geared towards increasing the income of the workforce, both the formal one as well as the informal one. This is where the Mint Leadership Dialogues in partnership with JSA come into the picture. This is really our attempt to go very deep into the challenges that come along with these goals through deep discussions with more than 40 leaders in some of India's biggest companies in 5 separate closed-door roundtables. The aim was really to find ways to tailor policies, investments, and of course even the work culture towards more jobs and higher incomes for Indians. So before we can let you have one of these and read it yourself, here's something I'd like to show you, our findings precisely. Let's watch. Well, that pretty much sums up the behind the scenes of the Mint Leadership Dialogues. And we're going to take the next couple of seconds to make sure that you have a copy of your own before you leave today. We have ushers around the room who are now going to distribute the books to all of you. Please make sure that you grab your copy. This is really a copy that is packed with insights that have come out of all of these leadership dialogues that we've had across various cities in the country. And we'd like you to make the most of this information. So while my ushers give you your personal copy, we are going to turn the stage around for what is going to be our first panel for today. And before we invite this panel, I want to invite all of you to join in the conversation and help us take this conversation to your online social media platforms. I know that as our speakers grace the stage, share their insights and share their thoughts. All of you have your own take on these thoughts and these insights. So please join us on your social media platforms. Share your thoughts, insights, your photos, your videos, your key takeaways. And when you do that, please don't forget to use hashtag MintIIS2025 so that we know where to find it. Okay, so gone are the days when private equity sat back like silent shareholders. Today's PE leaders, they roll up their sleeves, they jump into the boardrooms, and sometimes they even brainstorm product roadmaps. All of this comes into shaping the future of the companies that they back. Private equity today is no longer just check writing. It's really, ladies and gentlemen, is for who's ever wondered what it really takes to turn capital into conviction, conviction into compounding. We're just going to take a couple of seconds to set the stage up before we invite our panelists for today. Meanwhile, you can actually take the next couple of seconds to browse through the book as well as I invite our power panelists. In fact, I'm going to begin by inviting our moderator for this conversation, who has been on standby for a while now. Please join me in welcoming Ranjani Raghavan, editor, Startups and Deals, Mint, who will be in conversation with Vishesh Srivastav, Managing Director, Investment, Temasek, India. Nitya Iswaran, Managing Director, Multiples Alternate Asset Management. Hemant Sharma, Partner, EQT Private Capital Asia. Rohan Suri, Managing Director, KKR India Advisors Private Limited. Sonia Dasgupta, Managing Director and CEO, Investment Banking GM Financial Limited. And Iqbal Khan, Partner and National Corporate Lead, JSA Advocates and Solicitors. A very warm welcome to all of our panelists. And you know what? A power panel deserves a powerful welcome, everyone. Come on. We can do better than that. Thank you. Well, Ranjani, now you have all the power you need. Go for it.
Thank you, Xenia. That was wonderful context setting. And actually, Vishal's panel also did a very good job with setting the context in terms of how private equity is shaping up in India over the next few years. It's been largely buyout focused. And we have a stellar panel to essentially discuss that. Why investors are looking at buyout control deals, how are they scaling these investments after the deals consummated, and finally, the kind of exits that they are looking at. So perhaps we can start with you, Rohan. Rohan Suri from KKR. Can you tell us how the thesis has evolved for you at KKR, the buyout thesis?
Yeah, no, thank you so much for the invitation. Look, I think similar to what Vishal mentioned in his comments, buyouts as a, just as a market opportunity in India have seen, a very significant increase. So if you compare, the types of investment opportunities that we were seeing a decade ago to now, the proportion of buyouts that we see as opportunities has increased significantly. We are still, very flexible in terms of how we go to market. So our approach is, we are thematic in going to, looking at opportunities in sectors that we prefer. And so we look at minority as well as control situations. But there have been, I think, a few reasons why the buyout opportunity in India has increased in this last decade. I think first and foremost, I think private equity firms who've done buyouts in India, I think they've also, through their experience, gotten the confidence and conviction that buyouts as a strategy for the India market is a very, very viable and attractive opportunity. If you just look at our history as a firm, KKR's been in the private equity business for almost like north of 45 years. buyouts is something that we've been doing across the world for a very long time. But when we started doing the first buyouts in India, we went through that process of trying to make the global buyout playbook more relevant for the Indian context. And as we did that, we've, Touchwood had success in doing that, and that's also, I think, given us a lot of confidence that we can do and manage complex buyouts in India. Combined with that, I think Indian founders, families, entrepreneurs, they also now better understand what type of capital private equity, especially in a buyout context, can represent. So more than just providing capital, I think private equity capital can be very value additive for companies which are looking to go to the next stage in their evolution. So it varies, of course, from situation to situation, but companies may be looking to expand globally, and having a private equity partner which has experience in markets outside India could be a great partner as companies go through that journey. It could be companies which are maybe going through a period of succession, and as they go through that journey, having a private equity partner on board which has aligned incentives, but also then has the ability to attract talent at a level which would then help the company grow and evolve into the next stage of its evolution is, I think, another added advantage. So I think there are a lot of these reasons beyond just providing capital that private equity in a buyout context brings to the table. And the fact that now we've had a lot of examples and successful examples of buyouts which have created value for all shareholders, I think that's, it's a virtuous cycle. So now that flywheel is running, people, families, entrepreneurs see the value in partnering with private equity, and in private equity has also, I think, developed a lot of sophistication in how to do buyouts in the context. So
Correct.
I think that's the benefit that we're seeing today.
Yeah. We'll come to the use cases also of private equity, but before that, Hemant, if you can give us some sense of the kind of sectors where the greatest action in buyout activity is happening, and how your thesis has evolved around that.
Sure. Can you hear me? So first of all, thank you so much for this opportunity. Completely agree with Rohan's point here. We've been focusing on buyouts since 2013 in India. So we were one of the first private equity investors to focus on buyouts as our core part of our strategy. But alongside with that, the second thing we did is really to also be a much more sector-focused fund. And I think they go hand in hand. And so at that time, we really said, look, tech services, healthcare, financial services, and consumer were the four sectors we identified. And for the last 12 years, those are the sectors that we've really spent all our time on. Of late, we've been adding sectors like industrial tech to this in terms of forming our point of view and tracking companies there. But having tracking these sectors for a long period of time, having a full talent mapping of these sectors, having a very strong bench of industry advisors in each of these sectors is actually very crucial to our investment process. And that's closely intertwined with the whole buyout strategy, because you can, as a controlled buyout investor, really operate and own these companies with that playbook alongside. So that's one. The second part, I think we've finished over the last 12, 13 years, and we continue to do this, is actually just around the value creation playbook. And buyout without value creation doesn't make sense at all. The whole point of taking control is also to help the company grow faster, drive better governance. And I think there are many, many pillars of this which continue to be added to this. So we are now increasingly focusing a lot of our time on how we digitally transform a lot of our businesses, how we drive sustainability coefficients there. And there is obviously hence a deep operating team that one has to also build. And we've been investing ahead of time in building some of those capabilities.
Right. I want to come to you, Nitya, and then Vishesh. Nitya, your strategy at Multiples has also evolved. Like, you do a fair bit of growth investing and buyouts as well. Can you give us a sense of the kind of deals that you all have done and what you all are looking at going forward?
Yeah, Ranjini, happy to be here. Multiples as you know, we have focused on early growth and buyouts. But what has helped us stretch around this entire ecosystem has been really the mindset that you bring, which is a operator mindset, even in a growth minority kind of deal. Having said that, we have done 5 buyouts. It's not very well known that we have done 5 buyouts, but we have 2 in pharma and healthcare, 2 in tech and tech services, and 1 which was actually a platform built out in financial services. And as we look, at things ahead, a lot of my colleagues here have also said, that growth buyouts is picking up. And as we see that, we would want a lot more of our portfolio to reflect that. So going forward, I would say maybe 35 to 40% of the portfolio would be in buyout opportunities as we see that accelerating. And we did go over why some of this is happening. I think especially now that we see in consumer and industrials as well, families, there is an underlying succession issue, and families want to thereby leave the business in hands where it can grow further. I think the second biggest thing that is driving it is the whole talent alignment with a private equity kind of owner. It's just becoming very difficult to get top tier talent to come into an owner manager or what we classically call a promoter owned company, because the ability to have that great ambition to allocate incremental capital, to see the monetization of ESOPs, even if they are given, only comes with a private equity like owner. So I think that whole talent aligning with the private equity capital is really helping this. So we would expect our portfolio to also reflect
to
that.
continue going forward. Yeah. Vishesh, bringing you in now, you all have a different perspective. I know you mentioned about how what the company needs, the kind of solutions that companies need, and you look at growth and buyout from that perspective. Can you give us a sense of how that's evolved? And going forward, are you likely to do a lot more buyout deals?
Sure. Thanks, Ranjini. Thanks for inviting me to this panel. And, I must say that going 4th out of 4, all the interesting points have already been made.
Yeah, that's the challenge. Yeah.
I'm going to attempt something here. So, as you know, Temasek is a balance sheet investor.
Yeah.
We invest our own capital.
Yeah.
And that allows us to be flexible in what we do, right? So we don't have mandates that, this is what we will do and this is what we cannot do. So some things haven't changed, right? The areas of focus for us have been the same that they have been for the last 20 years. Since we've been operating in India, we focus a lot on, themes that resonate really well for India. Rise in consumption, increasing digitization, longer lifespans, and then sustainable living. The people that we work with also has been very consistent over these last 20 years. We look for like-minded partners. We look for people who have long-term visions, where there's an alignment of values on value creation, and difficult to describe, but you know it when you see it, an ownership mindset. And so those things I think will not change. So specifically, I think we try to be flexible in what is the problem that our capital, our involvement is going to solve. And examples of buyouts, for us, we have done, a consumer deal with a PE fund. We've done a renewables deal with EQT here, and we've done Manipal hospitals.
Correct.
So I think it's not a, for us, a allocation that, this much needs to go to growth or this much needs to go to buyouts. But it is about, the specific problem and what are we solving for? Are we solving for permanent capital? Are we solving for succession? Are we solving for, international expansion or what have you?
Yeah, yeah. Perhaps now we can come to the sell side, perspective. We have 2 advisors, both of whom who've worked in the industry for several decades. And, Iqbal, if we can start with you, can you give us a sell side perspective on how the mindset has changed from, companies earlier? Most of them were perhaps probably reluctant to give up majority control, but now that situation doesn't appear to be there.
No. So, I agree with everybody on the panel, whatever they've said. Why? The mindset change has been significant. I think one point, somebody touched on it but didn't go through it. I moved back about 10 years ago, right? I helped, Amarchan set up an office in Mumbai when the split was happening. Right about that time, what I saw was two phenomena were happening. One, a lot of promoter families, their second generations have gone abroad, studied abroad, and wanted to come back. And that promoter families were divided into two categories. One were, great business, but we want to diversify, right? So we are willing to share. And being lived abroad, worked abroad, educated abroad, they understood private equity. I think, many people have touched at that. So they were willing to give a stake and partner with those private equity to expand, to think about it. And that particular, the issue that we used to have as an advisors was what kind of control are we giving, right? What are our obligations? What are our liabilities? How we protect ourselves, right? So that was one issue that we always faced when we were talking to a promoter willing to let go. And we could always see the diff between the senior promoters and the younger generation which has come back. The second kind of, within the same pool, what we were seeing at that particular point was a lot of youngsters said, you know what, we don't want to run this business. Private equity was willing to step in, take that complete buyout, take the company, and the youngsters wanted to do was run a home office, their own family office, right? Their own capital. That was predominantly what I could see as a large change which was happening. And a lot of private equity at that particular point were taking significant minorities. They were not taking control, were starting to take control because they wanted to control their destiny. So the fight in the documents always used to be what kind of control I'm giving to the private equity if I'm sticking in it. What is my exit that's going to happen? I mean, Indian FEMA laws didn't make it easy to structure that very easily, but structuring was happening. So that was one thing that was happening. The second thing that I saw as an attorney and advising, a lot of these promoter families formed very good bonds with many private equity players, right? So, and they wanted to form these bonds because their next venture, their next investment, these private equity players already had in those ventures. So those kind of relationships that I saw was being built over there have continued for so long. So those were basically the change from an advisor's point of view.
Sonia, can you elaborate on that a little bit about the nature, the different kinds of sell-side companies that you've seen and the kind of, and also a little bit about the competition that private equity folks may probably see on the other side from strategics.
Yeah, so as an investment banker, I think the private equity buyout interest is a dream come true for us, right? Because it just helps, when we are on the sell side, it just helps us manyfold have a larger number of potential buyers for the same asset. So it's and the first rule of when you're on the sell side, the more competition, the more you can maximize the value for your client, right? And I think certain nuances which practically we have seen on the deals that we run on the sell side, and we run it across sectors. Sometimes when a strategic player is doing a sell side, they are a little sensitive to actually sharing their information to a competitor.
So
right?
it's easier.
Yeah.
With
And they are much more open to sharing that information with the financial sponsor, i.e. the private equity universe. To the senior management team of the target company. Sometimes, unless, if the buy side is someone in the same industry, a lot of their heads are going to get rolled, right? Because that is the first synergy that will come on the buy side from a strategic. And they know, like, Nitya alluded and, everyone alluded, that there will be sort of like an entrepreneurial platform when a private equity acquires them. So they are also very much incentivized to have a financial sponsor become their new owner, right? Because they can see an ability to, be a co-partner in the growth and of course, through their stake, make a lot of wealth. So I think these are two very important factors that we have seen. Also, for a strategic buyer, very often there is build versus buy, which plays a very, very important role. And very often we see at the margin internally that buy thesis somehow, if they have to give a significant premium, is somehow at some level is not something that is very palatable unless they want to make a pivot into a new segment which they don't have. Then of course, they will do it. But I'm just generalizing. But most of the times we have seen financial sponsors, because they want to get a platform, get into a new space, they have the ability to pay a top dollars for the same asset vis-a-vis, like I said, I'm generalizing for a minute, as a existing strategic who may say, I'd rather build it myself because I have the other ecosystem to do that. So I think that's very often tilts the deal towards the financial sponsor. And I think the financial sponsors, through decades of having done deals and exited, have now got the confidence that in India there is a regulatory support for them to be able to also exit, whether it is through IPOs, which we have seen literally the IPO exits in FY25 almost 3x versus what it was a couple of years back.
Highest ever.
And it's not only IPOs, but also secondary blocks, right? We are seeing larger and larger secondary. We've seen in some companies where it was almost a third of the free float that got sold via blocks. So the ability of the Indian capital markets with its depth to absorb that kind of selling and for the private equity to have, actually got that, gives them renewed confidence to come back to bring more dollars.
The virtual cycle, as our participants said. Now that we've discussed, why investors are finding it very lucrative, I was hoping to move on to how, the P firms think about scaling. As Sonia mentioned, the buy versus build conundrum that often investors have. If we could start with Nitya or Rohan, either of you, on what is the kind of expertise that private equity firms are developing in-house to be able to operate these assets and compete with legacy players often in many of these segments?
I'll kick it off, Rohan, you can add. I think the first, and several of us alluded to it, I would say bringing the owner mindset, right? And Vishesh, you said, hard to describe, but you know it when you see it. But I'll make an attempt to kind of describe it and use some examples as well. It's at the base, it's a very long-term mindset and not worrying about, the next MOC uptick that I can see on my investment in the next 2 years, which is, I would say, a little more investor mindset, but rather, to work with saying if we built a really good business, eventually we'll kind of get there. I'll use some examples. We built Vastu as a platform. And even before COVID, we had a few years where there was a little bit of a debt crisis, building in. And at which time a conscious call was taken to say, let's just focus on quality and let's pull back disbursements, right? Which is, so choosing that quality over growth, which may mean you stay on longer into that investment, but allowing that mindset to come in. So I think building that, it's very easy to say we need to have, skills to, go global, to do M&A. We will do all of that eventually, right? But it comes with the thought that comes in. And I think the other thing to do, which probably as private equity does better than, and Sonia, you alluded to it, is to bring, both the outside in and the inside out, where a manager would, just say, I can do this. Give me 2 years, I can build into this gap. Why do we need to buy it? But to be able to say that, this acquisition makes sense because we've mapped out the market. This is the gap. A case in point would be what we did with our animal healthcare business, Zenex, wherein we went out and made an acquisition, in the natural space, in the Ayurvedic space for, animal healthcare. It's something that people could build out, but we could see that we have a huge footprint and pipeline, and it's better to bring that in and then take it to to a very different level. So I think building that owner mindset and the rest kind of follows. But I'm going to stop here because there's a lot to say. Rohan will probably add to that.
Yeah, no, I agree with everything that Nitya mentioned. I mean, I would say a couple of things. One is, like everyone mentioned, if you're looking to do a buyout, there is, always going to be competition. There are obviously a lot of funds which have capital, which are looking to invest. Our approach has always been that if you're looking to do, to be successful over time, you have to have, deep industry expertise in the sectors that you choose to focus on. Because what oftentimes ends up happening when you're looking at a business, I think it boils down to, if we were owners of this business, what would we do differently if we had control versus maybe how the business has been run till that point, or if someone else were to buy it. So I think that insight only comes if there's a lot of focus or expertise that you develop over time. And so there are a couple of things which as a firm which we've prioritized over many years. One is, and people mentioned this on the panel, but working with people who've actually run businesses, senior managers, operators, who actually have experience running companies in a particular sector, and benefiting from their insight when you're evaluating a situation, I think is critical, because then you oftentimes end up thinking about a business from a more practical lens versus a purely academic lens. I think that's important. At KKR, we've had a team within KKR called Capstone for over 25 years now, which is basically comprised of people who have industry expertise, who run businesses. And so having that perspective when you're not just evaluating an opportunity, but then also when you're running that, I think becomes very, very important. And I think this point around which Nitya mentioned, I think is a really important point, which is private equity by nature is meant to be long-term patient capital. And the value that private capital brings to the table, I feel, is that you can do a lot of transformation work in a company in the private space, and not necessarily look at short-term outcomes, but take a more long-term view on what are the right things that you need to do by the business, and do that in a private context. So at the end of the day, that is really the value that private equity represents, and therefore companies which are looking to go through that transformational journey, having patient capital on their side, having patient partners on their side, ends up yielding better results from a long-term value creation standpoint. So I would say those are the two things. I think having that operator mindset, being patient, and also then having the industry expertise to have a differentiated view on a business, oftentimes I think is a difference between a good outcome versus an average outcome.
I'll just add, Ranjini, the only other thing which we are saying, which is, sector agnostic kind of thing, right? And probably will apply to our minority investment, but even more to our control investment, is just identifying and attracting the best talent.
Of course.
I think that intensifies, and that, in a way, that skill mindset approach you need to internalize, and then aligning them to the outcomes that you want, which means performance management, incentivization, and what are the best ways to do that? If that is one other skill which is core to being that operator and having control, is what we keep telling ourselves every day.
Yeah. I actually want to touch upon something that Rohan mentioned, the transformation, the element of transformation that comes through, and also what you alluded to, Nitya, about, Vastu early days of, bad debt that went through and the decisions that you took. So the question is, if, you go into an investment and then you expect a transformation, that's one thing. But say you go into an investment, everything's good, and then it sort of sees a decline. what are the steps that PE folks can take to sort of arrest that decline, or how do you handle it? And anybody can take that question if Hemant, Vishesh, or any of you.
Yeah, take that one. It's a hard question, right?
Yeah.
So I think, see, it's never a linear journey, right?
Yeah.
We always, every investment in a 5 to 7 year period, particularly in an emerging market, will go through speed bumps. I think, and I'm linking this to the control buyout orientation as well. What it allows us is, any situation really has two types of risk. One are foreseeable risks, others are unforeseeable risk. Unforeseeable risk will be a situation like COVID-19, right? And I think our own learning as a control investor has been that, just being supportive of the company during that time, letting them execute and firefight during that time, and then actually gradually nudging them to see the opportunity is actually very helpful. What we have seen is well-run companies will come out of an unforeseen crisis actually stronger. There will be bolt-on opportunities, there will be market gain opportunities, and I think that works really well. Then there are, foreseeable futures. And I think that's where a control buyout orientation and the ownership mindset that we talked about actually really helps, because one of the things we do is, how we nudge the management teams from a monthly or a quarterly review, which is generally what happened in the last month or last quarter, to move them to, let's not discuss too much, spend too much time on that. Let's discuss what's going to happen in the next quarter, right? And I think with the management team, the board, the investors, actually seeing things in the future, you start planning for things in the future and start anticipating, risks which could be on the horizon and take mitigating steps, right? Now, despite all of this, you will still run into issues, situations where, the company, for example, stagnates, is not performing well. And then I think where the control buyout again comes to play is really the ability to focus and channel the entire energy of the organization on that single factor, right? Because otherwise, in a complex organization, people just are doing their specific initiatives in different directions, and that often really helps to bring back, momentum or growth behind the company. You can obviously look at, acquisitions to perhaps, bolt on some capabilities in the company at that time. And you can also look at management interventions, right, if that's what's required.
Right.
Yeah, if I can just add to that, right, the framework we have in mind to think about, how a control deal should be done is that we think that there are two constituents. There is a board which sets the long-term vision, which manages risk, which signs off on long-term plans, and which sets incentives for management to follow, right, and sets very high standards of governance and so on. And then there is the management team who is running the day-to-day, who is executing to the plan, right, and both have to work in tandem to do this. I think, a lot of the points that Hemant mentioned, are absolutely valid. And, I'll just make this live by giving the example of a couple of our companies. Zomato today is a huge success. It's a very successful listed company. And Devyani, right, is also a very listed successful company. Both these companies, went through the shock in COVID, where suddenly revenue went to zero. And your costs were all there because you had a responsibility towards all your employees, towards all your customers, towards your suppliers, and so on. And these things will happen. I mean, you try to protect your investment from day one. You try to do all the things that will avoid risk, but they will happen. And then I think what works in this situation is just, again, coming back to that ownership mindset. We try to support our companies as much as we can with capital, with, I think somebody mentioned before, with, sometimes you play an agony aunt, you shore up confidence, and most importantly, you see the opportunity in the crisis, right? And both Zomato and Devyani, fundamentally reshaped their business models. And became much stronger. So I can confidently say that if COVID had not happened, our steady state margin structures in both these companies would be 500 to 1,000 bips lower than what they are.
Wow.
Right? And so, you just got to, to make the best of whatever situation you are in. And some things that allow you to make the best of that situation is long-term orientation, thinking like an owner, not like, I am an investor, I need to get out in 2 years, 3 years, whatever it is. And, this is my company, how do I fix it?
Right. I was wondering if I can bring Sonia and Iqbal on this as well. As outside in, as advisors, what have been the best practices? As observers, can you say, where buyouts have been really nicely done, or things that maybe a firm could have, done differently? I mean, in general, your observations.
Our role actually ends when the deal is signed. So we then start looking at it only when there is the next deal.
Yeah.
So I will defer to people who were holding the baby through after we delivered it to them.
Sure.
But I think very clearly the most successful buyouts have been where the chemistry has been right.
Right.
Between the buyer and the management team.
Right.
Right. Where either both are aggressive or both are opportunistic or both are long-term oriented. I think it's very important because sometimes in the spur of getting the deal, it seems that it's all right, but after a few quarters you realize that actually, and then they will obviously, because the shareholder will make those changes because they want a management team aligned to the way they want to run the business. So I think that first blip always realigns the chemistry between the two. And I think the way the whole incentive structure is aligned to be a bit more long-term, and I think the more experienced the specific private equity investor is in that space, the more they are able to actually give guidance and add value or see a few more farther into the horizon than even the management, because like sometimes they are first generation entrepreneurs, they are also learning on the go. But if the same private equity has seen similar companies in other countries or has the ability to see the evolution farther than the management team, I think that adds a lot of value to that franchise. And their ability to course correct, give them some tuck-ins to fill in some inadequacies, I think those are the ones that finally are also the best investments for that private equity investor.
Right.
So this is during the time of decline, right?
Right.
When there's an issue.
Yeah.
I have the best advice for everybody in the room. Call your lawyer, okay? That's the best advice. And we did get many of those phone calls during COVID. And COVID was a perfect example, right? Many of us had never seen a situation like that before. I remember the first 1 month, before COVID, I had about, like a $3-4 billion pipeline. The first 1 month was an absolute lull. And then it started. I advised on all the Reliance deals. That year was $20 billion on, each year after year till today it hasn't stopped, right? But what I saw during COVID was very interesting. This was the time your documents actually came out. Before that, a situation used to happen, right? Promoters were getting money. Arbitration regime was not that strong. Promoters used to say, "Arey bhaiya, paisa aane do, jo likhna hai de do." During that time, the documents really got tested. Control really got tested. Your veto rights really got tested. Because there were times where there was clear alignment. The promoter's mindset was aligned with the private equity investor, with the controlled investor. Clear alignment. But in reality, in India, it's very simple. You may have 51% control on paper, but it is he who runs day-to-day operations, and many situations, promoters have actual pragmatic control of the company, right? And what matters was my age-old, I used to always tell my private equity investors, right? Once you're going in, do not make it acrimonious. Make it a friendly input, go in the company friendly, have the proper protections for yourself. Because this is the time the protections really came up. So in situations where private equity and promoters were not aligned, documents had to be enforced. in a manner that everything that they said is absolutely correct, right? I'm the owner at 51%, I'm private equity owner. It's my interest to protect my shareholders and my LP's interest. So I'm going to do best, whether it's putting more capital, whether it's aligning ESOP's incentive plans again, or whether it's selling something, buying something, remodeling something, whatever needed to be done, I would do it. And that's what my advice has always been. It changed completely from that particular point. Promoters also started paying more and more attention to what rights they were giving up in those documents. So, in summary, call your lawyers.
Right. If anyone else has, Iqbal's advice on not just calling a lawyer, but documents coming out during COVID, like in times of disagreement, is that like has there been an experience for that you all don't want to talk about?
I should say, thankfully, no.
Yeah.
And I think there, I think Sonia alluded to that. The whole DNA match is absolutely key to say, and I think there's no point, actually we all hope we don't ever have to open those documents.
Yeah.
The day you have to do that is a problem day, right?
Yeah.
So while it's there for protection, but I would say that DNA, match is essential, and yes, 51% is not necessarily control. I thoroughly agree with that. I just want to add a different point. Another reason why probably some of the buyouts, when you do a buyout to really think about, is while we say sectors, right? If we say financial services is a sector, we would go on to further say within financial services there are certain businesses that are good to be owned by private equity and certain that are not. So mapping those subsegments and having clarity to say that why is this business going to be successful in my hands as different from a founder's
Strategic.
hands, a
Yeah.
promoter's hands. Understanding that is very key. Not every business, I believe, is suitable for a control. Certain things should be played as minority alone.
Yeah.
And I think that mapping as much deep that you can make it, it makes your thesis successful.
Yeah. I want to actually move on to exits right now. The thing that most private equity folks look forward to, I imagine. Now, with the markets becoming fairly volatile, how are you sensing, as buyout deals become larger and larger, do you sense that exits will become easier? Will you be able to exit completely through the public markets? Or will you have to look at other options? So I'll leave it open if you can talk about exits in the market. Rohan, you want to take it?
Sure. I'd love to start. I think the biggest change from an exit standpoint that we've at least seen in the last 4 or 5 years is how Indian capital markets have become a very viable alternative for exiting large positions. That's, I think, a huge step change that has happened. There was a time, 10, 15 years ago when foreigners were selling, our markets would see sharp correction. But I think just given how retail participation has deepened in these last 5, 7 years especially, the Indian capital markets are at a level of depth and maturity which frankly I think didn't exist 10 years ago. And what that's meant is, we had an investment in a hospital business called Max Healthcare where we owned, more than almost 55% of the business. It was a large investment for us. We were able to fully exit that position by selling down in the public markets. Now, 10 years ago, I don't think that was a base case outcome that we would have envisaged because frankly, our capital markets probably didn't have that level of depth and participation. Now that you have a very deep, well-functioning capital market ecosystem, I think it further, I think, increases conviction that investors have when they're doing large buyouts because in addition to the traditional sources of exit, which is, you sell to another sponsor or a strategic, you now have a very viable option of, taking the company public and actually exiting through public markets. And there have been numerous examples since we sold down Max, which has given confidence that it's not a one-off. This is now a long-term trend. And I think it's only going to increase. Where we are as a country and as an economy in terms of just retail participation in the financial markets, we're still at a stage where that's going to further increase. So I think that's a really, really positive development, which will further encourage investors to take buyout positions and investments in India.
What about I'll just add to that, because in this, if you see the stats over the last 3 years, the IPO size of the exits is on an average just 10%, right? If you say 60% is through the markets, 40 is through M&A, whether it almost equal P to P and P to strategic, of which 50% is actually blocks. Only 10% is through IPO, okay? So the point being that the IPO market, is just an enablement for that platform to become listed. Thereafter, they have a longer runway, longer time to do the blocks. And that depth of that capital market is unfettered in the sense there is no regulatory, filing or what have you. It is a very short window. They can time it, when they feel that, they are ready to take that exit depending upon the performance or what have you. So I think that vibrancy in the blocks that are enabled in the markets, I think that's a very strong tailwind for the whole exit mechanism.
Ecosystem.
And if I may add to this, right, I think I agree with whatever Rohan mentioned in terms of more avenues to exit. But, if you're in the right investments, and this, I'm speaking for our own experience in India, the companies that do well keep compounding for, decades. If you're in the right investments, liquidity is important. Of course, you should have the option of monetizing when you need to. But the investments that are made well, that find the right, need in the market and service it in the most efficient manner, sometimes, no exit is the best exit. And, we have examples of companies where we've been invested for 20 years and they are some of the best performers in our portfolio, right? Now, obviously, you can't do that all the time, but being in an economy like India really affords you that luxury, which you may not have elsewhere.
I'll just bring a different perspective. Sure. The avenues for exit are definitely increasing. We've had a recent experience. We've raised a continuation fund, which is $400 million plus. We put in our control investment, which is in Vastu, which our Vastu investment started in 2015, correct, 10 years ago, right? And we all live on 10-year funds. So having come to the end of that fund, the ability to roll that investment into a continuation fund, which gives it another 5-year life for us to stay with it, and this proliferation of this will allow us to have what Vishesh was saying, compound with the investment of good companies and stay for long. Have that patience, because while capital markets is a great sign, there'll be periods when it is not available. Correct. Second is the reason, for us, if you're a 100% owner, a 90% owner, 80% owner of a business, and you take it to capital markets, every day the capital market investors are going to worry, when are these guys going to sell, right? So this overhang is quite a bit. I would also worry about what happens to the 10th housing finance company or the 15th housing finance company that gets listed. Which capital market investor is going to be interested in that? So you have to build scale, diversification before you really take it out there. So something like this instrument, which is now becoming increasingly available of a continuation fund, helps us to do more buyouts.
Right. I think, we have a few minutes left. If we can take audience questions. Yes, Sneha.
In the context of exits, I had a question for Vishesh. Of late, we've seen that, private equity investors take controlling stake and within a year or two are trying to de-risk their investments, either by selling a very small minority to their peers. You've done that in Manipal, you've acquired some bit in VFS. So can you talk about a bit on that strategy, what exactly it is, where you take control and then try to de-risk it a bit?
Yeah, so I think, look, Sneha, your observation is correct. The motivations for that may not be, may not be only de-risking or taking liquidity, right? Because in the private space, what happens is sometimes, you want to buy, let's say, 52%. I'm just making this up. But what is available is only 60%, right? So what do? So then you buy 60 and then you find like-minded investors who will also add value, hopefully. And you sell them 8%, right? So I'm just giving you one example of, of how things, may evolve. Also, I think, this also sometimes, it has consequences which, may be positive for the company because it may reduce pressure on the company to list immediately, right? Very common example is, a company that has had, let's say, been in existence for 15 years and has had multiple investors, right? And has, someone who came in Series A, 14 years ago, also on the cap table, and someone who came in last year, right? And so things like this allow the company to solve for their cap table, right? So, a secondary may happen where the Series A guys may be taken out, and then that gives more room for the company to, execute on its plans. So I think it's really a horses for courses. I wouldn't call it a, something that is done consciously or as a strategy.
We have a couple of questions here.
Hi, this is Yash here. My question is for Nitya. You spoke about change of control from the promoters to investors. So I would like to have your viewpoint on what do you do when the promoters are not willing to hand over the areas of operations to the investors, where you feel you are a better person to take charge of that area. What do you do in that case?
After you invest, that becomes a very tough one to resolve. So actually, what we try and do in situations where promoters continue to be on the cap table, we've recently done an IT services deal which is of that nature. The promoters with a minority continue to be, is achieve that alignment upfront before you go in as to what are the changes you would do, what is that trajectory of that company that you want to build, and even more importantly, how would you exit if there's if there's a strategic sale. So you do have your abilities built into documents, but I think it's important to align it much upfront. And Hemant mentioned about the value creation playbook. To have alignment on that playbook right before you go in and within 100 days of you really getting in there is absolutely key. There is no point later on throwing the document on people and trying to, because by then the disputes have really begun, right? So we would tell ourselves every day, do it before you go in.
Can I just add to that particular point? I completely agree with that. We were doing a $4.5 billion deal about 2 years ago, and I was representing the acquirer. They were exceptionally clear that this deal I will not do if the promoter doesn't sell me majority. So to your point, we had all the protections in the document because we knew the promoter had a lot of control on the ground, could spring back into action. We had taken care of the documentation, but we were very clear. We wanted to bring him from control to 9.9%, where he didn't have any rights in law or in the documentation. So completely agree with her particular point. And to the point that's even more important, you don't want that to happen after you're inside the company. You need to take care of that prior to investing. And if that's your thesis, you don't want to do the deal, trust me, don't do the deal as compared to then going and litigating against a promoter. Not a good place to be if you're a private equity investor.
Thank you.
A couple of questions from this side.
Hello. Hey, hi. This is Vibhor from Houlihan Lokey. So, we've been dealing with few fund clients as well of ours And there have been interesting stuff going on with the continuation vehicles. So I just want to understand, how do you sort of also see pricing of assets when there is a continuation vehicle exit going on? Because from an LP's perspective, they can prefer an IPO, they can prefer some other liquidation methodology, but are there any concerns, and how do you sort of address those concerns from LP's perspective and in the case of continuation vehicle?
I'll take that since I brought in the continuation vehicle into discussion. That it is the single largest conflict issue, right? Because the GP continues on the other side. So there are some safeguards built in. One is your investors into the continuation vehicle, who are third-party, large institution, price the round, so to say, and the terms of the deal, of the continuation of the GP into that. I think the second measure is you do have to offer your existing LPs ability to roll over. So if you are interested in continuing your investment from here into, and certain LPs do take that, so you can continue with the investments. If you do feel it's a valuable investment, it kind of goes on. And I think the third biggest discussion that happens there is, why you want to, why this investment, you've come to the end of your fund life, you still believe it's a very significant, runway left. And specifically in our case, in the few investments that we put in there, we had also shown exits, along that journey. So it was not to just say we were lazy about it, to stay with it right till the end and then push it into the continuation vehicle. But it is a dialogue and very, very well governed into the fund documents, actually.
Okay, we have time only for that, actually, so we'll have to conclude here. Thank you so much to our panelists for taking all questions very sportingly, and thanks a lot to our audience as well for listening.
And thank you, Ranjini. Thank you for asking the most pertinent questions. And Ranjini, I'd like to request you to kindly present a token of our gratitude to our absolutely amazing panelists. Thank you for giving us a lot of food for thought this afternoon. Requesting all our panelists to please come together. Let's just take a quick group photograph. Meanwhile, ladies and gentlemen, stay glued to your seats because we're quickly moving into our next session, one of the most awaited ones, of course. In the age of loss aversion, anchoring bias, also the infamous recency effect, investors often behave less like rational economists and sometimes more like day traders on espresso shots. It's time for us to invite our next speaker, who's going to decode how mastering the soft science of investing, our own psychology, is fast becoming the sharpest alpha generator in a modern day portfolio strategy. Markets go up and down, but what if the real volatility is our own minds? Let's talk about the FOMO, the YOLO, the I knew it all along bias, the psychology that moves markets more, macros less. But investing isn't just about models, it's also about mindset. And that is where the behavioral edge comes into the picture. Our next speaker, with his rare mix of number crunching intellect and human first insight, is going to talk to us about the quirks, the blind spots, the instinct that shape investing much more than we generally admit to it. If markets are driven by emotions, and if that is true, then ladies and gentlemen, I must admit that this is possibly going to be our therapy session for today. So please stay glued to your seats while I prepare to welcome on stage our next speaker, Nimish Chandan, CIO, Bajaj Finserv Asset Management Limited. Welcome, Nimish.
Good afternoon. Hi. One of the best minds of the last century, German physicist Max Planck, father of quantum theory, once met the then celebrated economist John Maynard Keynes. And Max expressed his interest in economics when he was a student. And he said, I wanted to pursue this, but I found it too difficult, so I gave it up. Keynes was surprised that a guy who would probably finish the entire economics book and economic math overnight, what did he find so difficult in economics? Well, the answer was that in physics you are dealing with elements that don't react emotionally, but in economics you do. Unfortunately, economics since the 1950s actually was more interested in being like physics. There is a term for it called physics envy. They wanted the input-output cause-effect relationships to be exactly like physics. I have classified a few investors with taking some liberty to tell you about how Nobel Prize winners thought and how actually investors thought. Harry Markowitz, in early 1950s, was a student of linear programming. When he was 25 years old, he went to his dean to ask him what subject to take in terms of thesis. While waiting in the room to meet his professor, he met a stockbroker. And the stockbroker asked him, what do you do? He said, linear programming. He said, why don't you try it on stock markets? Harry said, I don't know anything about stock markets. The stockbroker said, it's not very difficult. The dean also joined. The three of them discussed and they said, yeah, we should work on a risk-return profile on the stock markets. Harry Markowitz, who was 25 years old, agreed to it, prepared a theory. Calculating returns was easy. Returns was gain in stock prices is return. But what to take as risk? During those days, even the benchmark S&P 500 wasn't there. So, out of convenience sake, Harry Markowitz took volatility as risk. He published a paper on that, and he won a Nobel Prize on that. Based on that, the entire economic framework and the financial framework of theories was built. Volatility came as the most important risk that investors have to worry about. Efficient frontiers were drawn to asset allocate based on that. One of the journalists once asked Harry Markowitz, sir, now that you know the risk return of every asset class, how do you invest your personal money? Markowitz said, I invest 50-50 in equity and bonds. Because if I'm invested 100% in equities and the markets crash, I won't be able to sleep. And if I'm not invested in equity and the markets rally, I'll regret it. So the person who gave us volatility as a risk himself invested based on behavioral comfort. The second person is Irving Fisher, again, one of the celebrated economists of the last century. Irving Fisher was also interested in timing the stock markets. And once he came out with the statement that from here on, equity markets will forever be on a higher plateau. Stocks won't come down from here. Unfortunately for him, he made this statement three days before the 1929 crash. For the next 3 years, he was fighting that how he was right and the market was wrong. And I've heard that he even lost his house in that. Also Nobel Prize winner. The third Nobel Prize winner, Myron Scholes. Everybody knows about the Black and Scholes model. Again, a model built on expecting human rationality. Won a Nobel Prize. Was a co-founder of a fund called LTCM, Long-Term Capital Management. I wonder why the name. Because they used to mainly do arbitrage. A lot of people tried to copy this model when they were successful. At one point of time, the fund NAV just collapsed. The people who were copying them also saw sharp erosion in wealth. The Federal Reserve called a meeting of all the affected parties. And believe you me, there were not enough leather chairs for the participants to sit in the federal boardroom, the celebrity bankers were sitting on foldable steel chairs to find a solution. These are brilliant minds, but what was the mistake made? The problem was human beings were taken as rational, people are not affected by emotion or bias, more like we are like robots who are operating in the market. Now let me come to the other side. When Harry Markowitz was waiting to meet his dean, at that time Benjamin Graham, the guru of Warren Buffett, was writing a book called The Intelligent Investor. Any investor who's a fundamental from a fundamental investing school would know about this book. There are no valuation formulas in that book. So why is this book so important? On page 8, in the very introduction of the book, Benjamin Graham writes, in this book, we'll be talking a lot about the psychology of the investor because the chief enemy of the investor is likely to be himself. Did not get a Nobel Prize, made a lot of money. Soros, I'll not talk about his political views, but he wrote a book in the 1980s called The Alchemy of Finance. He said, I have a problem with economics. They don't account for reflexivity. They only talk about that more buyers come and the stock prices go up. They don't actually see the effect of higher stock prices attracting more buyers. Made a huge amount of money in practicing reflexivity in the market. And of course, Warren Buffett. Warren Buffett, if you see his desk, you won't find any large monitors with complicated calculations running on it. His philosophy, be greedy when others are fearful and fearful when others are greedy. This is a set of investors who actually took human beings as normal and that they are prone to errors, driven by emotions, driven by narratives, and made huge wealth in the market. These investors had the behavioral edge of controlling their own biases as well as taking advantage of market biases. If you see the history of finance and investing, you go back 400 years. Events are different and distinct, but the patterns are common. I've taken excerpts from books, important books on investing of 3 different centuries, talking about the boom and bust cycle during their times. The first is the famous book, Extraordinary Popular Delusions by Charles Mackay. Here he's talking about the Dutch tulip bubble, the South Sea bubble, where Isaac Newton famously lost a lot of wealth. What does he say? He said, investors, people, populace, they generally get attracted to a particular asset class driven by narratives and sentiment. They take that asset class up very high in valuations, and then those valuations don't sustain. People get disappointed. They go chase something else, and the value of that asset crashes. And it's a human behavior that leads to this boom-bust cycle. In the 1900s, famous trader Jesse Livermore in his autobiography writes, the stock markets don't change. Investors may change, securities may change, but the stock market never changes because the human nature doesn't change. And after the 2008 crisis, when Kenneth Rogoff and Reinhardt studied the 2008 great financial crisis and the 50 years of crisis before that, in the end, they come to a conclusion that countries change, institutions change, but human nature doesn't change, and that was what causes the boom-bust cycle in the market. It is very important to have a behavioral edge if you want to create alpha or outperform the crowd. The most talked about behavior or emotions in the market are greed and fear, and most people talk only about them. Actually, while I have studied about 80 of them, we found about 40 of them which are some of the important biases, and 16 out of them which are important and more common biases that come into decision making. There are some tools I'll end with which can help de-bias or re-bias and help you take advantage of the market psychology. We are bombarded with a lot of information, but are we really able to handle information the way it should be? Amos Tversky, in a famous research, wrote about how people should be distinguishing between the strength of a signal and weight of a signal. I'll not go into details of the paper, but think about if you're trying to see if a coin is head biased, you toss the coin 10 times, you get 8 heads. That's a very strong signal. You toss the coin 1,000 times and you get 650 heads. Now that signal has a weight, even though the strength is low. Screening for overreaction and underreaction, where the market is greedy and where the market is fearful, where the market has underreacted to a positive news and where the market has underreacted to a negative news. The studies are surprisingly 40 years old, and we backtested them in India and actually worked. Richard Thaler and DeBont talked to us about the reversals and how over 3 to 5 years, losers outperform winners, they change roles. And Jagdish and Titman show us how momentum works in the short term, that winners remain winners over a short period of time between 3 months and 12 months. These are screeners that help you know where a sector, theme, or a stock is. From Atul Gawande and healthcare side, we took an important tool called the investment checklist, and something that is a very simple tool to use while making investments. It acts as a cognitive net. It acts as a guardian at your investment doorstep to check investments and evaluate things unbiased way before investing. I used to be a fan of Devil's Advocate when it comes to screening of ideas, but over the years I found a very important tool called pre-mortem. Gary Klein and Daniel Kahneman have a fantastic paper on it, how you can actually imagine, say you are in 2027 and you made an investment way back in 2025, assume that it has gone bad, and then write down what reasons it would have gone bad. That gives you a bear case scenario. The similar way you can make a bull case scenario. Pre-mortem before investing actually tells you about the exact risk rewards that you can see in the investment, and also what can be the trigger for exit. From aviation and a book called Black Box Thinking by Matthew Said, we took an idea of having an investment journal. Investment journal is like a black box for fund managers. As the black box records the decisions taken between pilot and the co-pilot, so that if there is any error, it can be corrected. The same way in investment journal, every investor should hold it to decide if an investment, while numerically it may show a gain or a loss, whether the argument for buying or selling that was right or wrong. And you can differentiate also between luck and skill. On bet sizing, there is an interesting formula by John Kelly, although he made it for bet sizing in a casino, but it works very well actually in portfolios. And Nassim Taleb also talks about it in his book, Skin in the Game. This is an important tool to get a model portfolio based on the risk return that you see in your securities or investments that you're tracking. Pre-commitments. After one gets into an investment, you have an endowment bias. You feel that's the best investment ever anybody could make, and you would only want to meet people or talk to people who agree with you. Doing a pre-commitment that if there is a risk in the company or a investment that you make, you have to put a pre-commitment that if this goes wrong, I'll exit. For example, if you've got into a company because of higher earnings growth, the moment the company gives a profit warning, it's time to exit rather than arguing. We use a lot of tools which actually help nudge the behavior of even our own investment team. Nudge is better than push. Push increases stress in the system. Nudge actually gets the same result by de-stressing the system. And last, create simulations and stress tests. Create scenarios which help you take a decision of what kind of portfolio loss or portfolio gain that one can have, and that can help better understand the portfolio and better time your entry and exits. All right. Thank you very much.
Thank you so much, Nimish. I'm going to request you to please stay back with me as I invite Alokesh Bhattacharya, Deputy Managing Editor, Mint, to please join us on stage and present a token of gratitude. And I must say, on behalf of everyone in the room, that was a phenomenal presentation. So much food for thought and action. Ladies and gentlemen, a thunderous round of applause, please. These are really the insights that complete the loop around the many conversations that were happening at the Mint India Investment Summit. It is time for us to recharge, reconnect, and be back in your seats at 4:35 p.m. sharp, because I can promise you on the other side of the break, things just get bigger and better. See you back in the room. Thank you. And gentlemen, thank you so much for joining us back in the room timely. You are at the 8th edition of the Mint India Investment Summit, and I promised you that the second segment of the summit is going to be bigger and better, and we're going to deliver just that. 2024 was the warm-up, but 2025 is when the real listings will hit the pitch. From tech companies preparing their DRHPs to old school businesses becoming digital first, our next speaker is here to bring us insider insights into what's going on in the IPO pipeline. Please join me in welcoming on stage Bhavesh Shah, Managing Director, Head Investment Banking, Equirus Capital, who's here to tell us what investors should keep their eyes peeled out for. Let's welcome him with a warm round of applause, everybody. Come on.
Good evening all, and thank you Mint for having us here. I'm going to talk about the IPO markets, the IPO trends. Very quickly about Equirus. We are a full-service investment bank, and we straddle across private equity, M&A on the advisory side, and capital markets, IPOs, QIPs. So that's what we do. Very quickly, I'll talk about the economy. We all know this. We are on our way to becoming the number 3 economy in the world, led by manufacturing. And I think a lot of our macro parameters are very much in control with fiscal deficit, etc. I think that sets the stage for a good runway for growth for the country. In terms of markets, this is the market trend from 1980 onwards. We're seeing a significant rise of wealth creation which has happened. In the last, leave alone the COVID bounce back, but if you just look at how the market has done in the last 5 years, it's been about 65% up. But when you look at a 10-year decadal returns, it's anywhere between 10% to 20%. So it's a consistent growth that the market offers. This sets a background for the IPOs in the market. Now, the other very big thing which is happening in the market is the shift of the flows, the kind of flows that is coming into the market. We used to be dominated by FIIs, and a lot of the FII money continues to be cyclical. I call it moody capital. So sometimes they are there, sometimes they are not there. But that led to a lot of cyclicality even in the IPOs. So today if the markets are doing well because FIIs are investing, companies will start preparing for the IPO. But by the time they're ready, the FIs are gone. Now with the advent of domestic capital, retail investors investing in mutual funds, this trend has completely deepened the market. It's on the way. And on the right-hand side, you can see charts about how the gap in the FII holding and DI holding has come down. So it used to be 7%, and now the gap was 7%, and now it is neck to neck. So FIIs and DIs own as much as same in the companies in India. And this is largely led by a huge amount of influx into the mutual funds in India. The left-hand side chart shows you how the SIP money has been coming every month. 25,000 crores worth of money comes into mutual funds. Today, the total AUM of the overall mutual fund industry is 64 lakh crores. And 35% of that is equity money. So there's a huge amount of equity money sitting out there with the mutual funds. Now, this is a multi-decadal kind of IPO trend, which we can see. This is right from 2001 till now. This is how the number of issues have happened over the last so many years. We saw a big amount of activity in 2004, 5, 6, 7, before the global financial crisis happened. There was a major lull which happened in a few decades thereafter. But in the last 4 years or 5 years, we've seen activity come back in the IPO market, and almost like 40 issues per year, at least every year. I think with this, the fund raising it through the IPOs is one of the highest that we have seen historically. And we saw last year raising about 1.7 lakh crores. And this is humongous, this is very big numbers. And let me show you the slide thereafter. This is a very big phenomenon that is happening. It's a tectonic shift which has happened in the Indian capital markets. What this slide says is, what we have been able to do in the last 5 years is more than what we were able to do in the 20 years before that. So this is a 25-year history of the capital market fundraising. And if you really look at how we did from 2001 to 2010, the first decade of the century, we raised about 2 lakh crores, and the second decade against the same. But in this decade, only half of the decade, only 5 years, we've raised double of what each of these decades have done, and in fact, the same as what the 20 years we have been able to raise money. I think the average IPO size has also gone up. I think understandably because the mutual fund industry and the institutional investors also want, as they grow bigger, they also want bigger sizes to play with. So which is why we are seeing off late the average IPO sizes going up. This is a very interesting chart again. Subscribing to IPO has led to significant amount of wealth creation for investors. And if you see over here, in fact, all IPOs which were there in 2021, the investors till date have made a 65% return. All the IPOs done in maybe 2024, there have been returns. I think it was only this 2022. And I think maybe perhaps because of certain issues, which were large issues which were there in that year, the returns are not measuring up. But otherwise, I think the capital markets has been giving a good amount of returns to the investors. And I think a function of that is a lot of these companies are high growth companies. They are beautiful businesses with robust business models, very good sound corporate governance that they have. And I think they are all being priced very reasonably at the IPO time. There's a lot of increase in the offer for sale as a component. There used to be a time when investors will ask for whether the money being raised is going in the primary or is it going for offer for sale. And if it's going for offer for sale, the investors would ask, why should we pay for somebody else to exit? But in today's scenario, we are looking at not only secondary sale from investors or maybe private equity investors selling, but even sometimes promoters selling their shares. And I think the phenomenon has completely changed because the investors, instead of investing in a cash-hungry businesses, they would rather invest in a cash-throwing business, take a secondary from the promoter, and kind of see the company grow on a regular basis. I think this was talked about in one of our earlier panels as well, how the private equity exits have benefited from capital markets, not only through the IPO, which kind of sets the tone for the future exits, but the blocks also kind of come in. So last year, I think almost 85% of private equity exits happened through capital markets. Now, this is a very, very big trend. It kind of, in our view, this is going to help private equity funds raise more money. And today, as we speak, the dry powder for private equity investors is also on the rise. I think let me step back on the tech journey which happened a few years ago. We saw a lot of investments happening in the tech space, a lot of money being invested in companies to burn money to grow. We saw valuations increase very rapidly, and these are some of the examples of how maybe Byju's examples or how the numbers just kept increasing within a very short period of time in terms of valuations. We saw many, many unicorns coming through. But this moment, the companies got listed. The capital market is an ultimate test in terms of fundamentals in corporate finance. So while all these IPOs did very well in terms of subscription, etc., But when it came to quarterly disclosure or when it came to performance, I think investors started asking very critical questions about, customer acquisition cost, how can it come down? How can you kind of make the profits, come back? And we saw a deluge of this erosion of sorts happening in this stocks. So Zomato came down, Nykaa came down, PB Info, Mamaearth came down for various reasons, but the common theme was, where's the profitability? I think just a case in point, Zomato took these points and feedback very critically from the investors, and they really worked hard to kind of, reposition their business model to making it more profitable. And the moment they announced the first profit, the markets took it very nicely, and we saw a very big jump in the secondary market value creation. We talked about Zomato in the early panel as well, where Temasek has invested, and this has done very well for them. So like this, I think we saw a lot of activity in the private equity coming down. Private equity quickly realized that if you want your companies to be listed through an IPO, you need to have profitable growth models. You cannot be burning cash for growth. And which is why the funding came down steadily over the last 3 years. But frankly speaking, if you really were to look at an aggregate of all of these years, we are talking about a $175 billion worth of money which has been pumped into private equity industry by the investors. Now, all of this is going to come back either in the markets or to strategic exits, but a good chunk of it can come to the market. So talking about the future in terms of pipeline, some of this will definitely come in. And we also did an analysis of how the pipeline currently looks like for maybe 2025. And we are talking about like 49 IPOs which have been cleared by SEBI, looking to raise about 84,000 crores. We have another 67 documents which is SEBI is yet to clear, and that is looking to raise about 1 lakh crores. We already raised 15,000 crores till March. So we are on our way to maybe raise, basis this pipeline, 200,000 crores. But the bottom chart is even more interesting. When we track the companies looking to or announcing their intention to go public, we suddenly discovered a number of 400 companies. And everywhere there is no estimate of issue size, but wherever there is an estimate of issue size, we have totaled that up, and it comes to 6 lakh crores. Now, these are companies where intention to go public has been announced. Out of that, only the amount in some companies has been disclosed, that totals up to 6 lakhs. It doesn't cover companies where the intention is there but is not out in public. So we are talking about a real big number here. And add to that the private equity, $176 billion I showed in a previous slide. Some of those companies can come in. And as we speak, we're seeing a lot of foreign companies also looking at India to list. We already saw Hyundai, LG is looking at listing in India. And we are talking to a lot of foreign companies as well, MNCs who want to see if they can get their Indian operations listed. One more key trend which is happening is the pre-IPOs. The secondary market investors are kind of pivoting to see if they can catch them young and see them grow. So on the markets, of course, the valuations being whatever they are, IPO market valuations are reasonable, but they don't get enough allocation. So the investors are trying to see if they can get an allocation even before. So we have seen a number of pre-IPO examples happening. On the left, you see the companies who have done that. On the right, you see the kind of investors who come into pre-IPO. Yeah, that's it. I'm happy to take any questions.
Sure.
Good evening, sir.
Go ahead.
So my question is, we faced that Paytm came up with IPO, and the valuation was 18,000 crores. And then later it faced volatility issues, and we saw that how stock market sentiment was also in a very significant structure. So what was the intention to bring the valuation to 18,000 crores?
I wasn't there on the deal, and I wouldn't comment on the specifics of the deal there. But I think, when we, generally speaking, we see a lot of companies trying to think that when they go public, they should get the best valuations. And that not only goes for investors who were there in the specific company that we were talking about, but sometimes even the promoters. A lot of times there's a lot of hard work that the promoter puts in to get the company to where it is. And there's always a mindset that, when my company is going public, it's kind of an endorsement by the public that I've created such a big company and it is worth so much. So generally the tendency is that my valuation should be the best valuation. But unfortunately, we have seen that sometimes when you price the IPO so aggressively, the price kind of corrects eventually, and that kind of does not work, even forget the investors, but even for the promoters, because he has to get his valuation back. I think the realization has started coming in, both for the promoters and even the investors, that IPO is not the end of it. IPO is more like a step in the journey for a value creation. And, just price it right, and you will be able to create more exit opportunities eventually in the market. And I think that realization start coming in, which is why in one of the slides I showed how the returns have been made by the investors. So I think, we see still some cases where the valuation aggression is very high, but at the same time, we are seeing a lot of sanity now starting to prevail, both on the investors and on the promoter side.
So just one concern here. You mentioned that 80 to 85% of exits are happening. You mentioned in one of your slides, from private to the public platforms. So that can again be a concern. So Paytm has not touched at all-time highs since the beginning. So if I'm an investor and I don't know the entire mindset behind the game, so my money is blocked and I'm losing opportunity cost as well. So how can I play smart here?
No, I mean, you're talking about yourself as a retail investor, but
Right.
most of this is more at the institutional level, private equity being institutions, and they look for larger institutional investors to kind of, sell. But I think, for retail investors, I think I also showed you one slide how the SIPs have been increasing. I think the best way to play the market in general, I'm not a great wealth advisor, there may be so many others, but probably the great way to play is not invest yourself, but give it to professionals to play. So I think that might probably help you.
Thank you so much.
Thank you for your question. Well, actually, that's all the time we have with Bhavish right now. Can we have a huge round of applause for Bhavish and Alokesh? May I request you to please join us on stage and present a token of our gratitude. Requesting you, gentlemen, to please come center stage. Thank you. Let's have a warm round of applause, ladies and gentlemen, for Bhavesh Shah, Managing Director, Head Investment Banking, Equirus Capital. We're going to quickly turn the stage around for our next speaker, and while that happens, I want to thank all of you for joining us in the online conversation. For those of you who've joined us recently in the room, please share your thoughts, your takeaways, your insights on your social media platforms. And when you do that, don't forget to use hashtag MintIIS2025. Now, if India's startup story had a prologue, it would feature our next speaker. From the thick of Snapdeal's rollercoaster journey to the wisdom he now brings to early stage bets with Titan Capital, he has seen it all. Unicorns, pivots, and everything in between. For our next conversation, all of you have a front row seat into India's ever-morphing startup jungle where only constant is the hustle and the only one sure thing is change. I'm going to give this a couple of seconds while we set the stage for our next conversation, which is titled Evolution of India's Startup Ecosystem. Please join me in welcoming on stage with a warm round of applause, Kunal Bal, co-founder, Snapdeal and Titan Capital, promoter Unicommerce, who will be in conversation with Alokesh Bhattacharya, Deputy Managing Editor, Mint.
Hi, good evening to everybody here. You know, there's really nobody better than Kunal Well to come and talk about the evolution of India's startup ecosystem. He's one of the biggest stars. You know, there are so many unicorns today, and there are so many founders. My wife wouldn't know anybody's name, but she knows his name. When I said I'm going to interview him, she was like, okay, that's good. So one of the early pioneers of the e-commerce and the entire startup revolution in India. I remember a couple of years ago, or maybe 3 years ago, I was checking how many startups are recognized. It was about 4,000 or so. Today, it's more than 1.5 lakhs startups, number of startups that are recognized by the DPIIT, which is a huge, it's actually a revolution. Kunal has been there from the very beginning almost, right? And he has seen all the happenings that have happened, the peak of 2021, the fall of 22, the return of 24. Yeah, so great to have you here with us, Kunal. Thank you for sparing time for us. And of course, apart from being a founder, he's also a very strong investor now. He's invested in more than 250 startups. So let's start. Kunal, after you take some water. And, you know, like I was saying, you've witnessed the Indian startup ecosystem's, you know, transformation and evolution firsthand, right? You were right there from the beginning. If you look back to your early days, what are the hurdles that you faced at that time that you think are not there or not so critical today?
Firstly, it's a pleasure being here, and thank you for inviting me to this great event. I was talking to Ravi earlier that this is, I think, the 8th edition.
It is,
which
yes.
is fantastic. In today's day and age, to sustain a media platform over 8 years is quite an accomplishment. So congratulations to the team. And thank you to everyone who's in the audience. You know, I'm often asked, like, what... I started my entrepreneurial journey with my best friend from school, Rohit Bansal, 18 years ago. And 18 years ago, there was nothing known as a startup, right? You either joined a family business or you did a job. This twilight zone of two 23-year-olds going and starting something of their own without family money and with other people's money, with no revenues and no, obviously, only, you know, some minor losses.
No monthly income.
Yeah, well, almost no income also. And people giving you money in exchange of shares in your company, something which is now national parlance, thanks to you know, so many startups and, you know, TV shows, etc. That was not the case then. So I'm often asked, like, what has changed over the last 2 decades? And I respond saying, what has not changed? Everything has changed, right? The quality of founders, the quality of thought process, the number of investors. I remember there were all of 6 investors back then in India, and most of them were like US returned professionals or bankers or consultants, etc. Right. They themselves didn't have a lot of understanding of the Indian market, so it was sort of like very difficult to converse about what we were building. There were all of 7 million internet users in India then, right? So you can imagine the business models that exist today, most of them just could not exist at that point in time.
Correct. Absolutely.
So almost everything has changed. Like regulations have come and gone, founders have come and gone, investors have come and gone. You know, everything is very different. And I can tell you the next 10 years, it's going to be the same. When we look back to present day and we ask, oh, what has changed in the last 10 years? I can tell you everything is going to change all over again.
What are the main things that are going to change, you think?
Look, I feel that after the dawn of the internet, which was, let's say, late 90s, after about 25 years, we are seeing probably arguably the most significant tectonic plate shift with AI in the world of startups and the world in general. There have been a few other waves that have come last few years, right? Like Web3, crypto, blockchain, etc., which also I'm sure many blockchain conferences have happened in our country.
Absolutely.
But clearly all those waves have waned. I can tell you this AI, if you want to call it a wave, it's not a wave, it's a new way of doing things. It is here to stay. And almost every business henceforth is likely going to have to adapt to this new way of building businesses and new way that the world will work. And it's going to be a very, very exciting world we are going to live in.
Right. Could you also tell us a little bit about what challenges are there today compared to what you faced earlier? I'm sure the challenges would also have changed. What should investors who are looking up to you as a mentor, imbibe from you in terms of how to go about facing today's challenges?
I actually feel it's become incredibly easy, much
Really?
easier to build a business because, compared to, let's say, 7 million internet users, when you have billion, and many of them having a smartphone, the market has gotten so deep.
Yeah.
And so many new segments have emerged. 10 years ago, in the world of e-commerce, you had one homogeneous lump of consumers, mostly urban, affluent, connected consumers. Now, every possible segment that you can imagine and every possible cut you could put by geography, by income demographic, gender, age, usage pattern, preferences, there are large pools of users in every single bucket now. So it's now more a question of the founder's ingenuity to come up with ideas to go after those segments as compared to does the market exist or not. Also, the per capita GDP is going up, right? Like in pockets, certain states are now up to $4,000-5,000 per capita GDP. Yeah. So they are the size, they are at the level of an Indonesia now. So all this while we've been saying that when will India get to 4,000, because that seems like the tipping point, $4,000 per capita GDP, that seems like the tipping point. Some states are getting there. And as a result, you're seeing some businesses are getting there also now in terms of hitting inflection points.
Right. A few years ago, I remember Mr. Narayan Murthy had once commented that not much market research is done before launching a startup in India, which is why many startups fail, right? Is that the case still now? Is there a need to do any deep market research considering that the pool is so vast now, like you're saying? And what is the rate of failure now? You are investing in so many companies.
Yeah, look, I think rate of failure will be, there will be a disparate number depending on the investor. But to your question, which is a good one that you mentioned about what Mr. Murthy said, it absolutely holds true even right now. Founders are going to spend 10, 15, 20 years building their businesses. You shouldn't be deciding what you're going to do for the next 15 years of your life in a weekend.
Yeah.
Right? I always encourage founders that at least spend 5% of the time on the pick. If you're going to spend 10 years of your life building a business, you can spend 6 months or 3 months or 4 months deciding what you're going to build in.
Right.
Because the worst thing is getting committed to an idea very quickly because you feel some company in the US raised $100 million last weekend in this particular idea. Nobody's doing it right now in India. Let me be the first out of the door and raise money first and then so on and so forth. In the end, you may fall out of love with that idea in 3 months when you realize how hard it is. Because what typically happens is whenever you start a new venture, a lot of excitement, a lot of euphoria, you're all pumped up to show up to work. And then there is this valley of death that comes when nothing is working, perpetual rejection all day long from morning till night. Nobody wants to come work for you. Nobody wants to be your customer. And resilience gets lost in that valley of death when you don't have core conviction behind why you are in this business. You didn't put in the work. And hence I always tell founders that, look, now you're spoiled for choice, right? You can go after so many different opportunities in India. You can build a consumer business, a SaaS business, a marketplace, a brand, a logistics company, a fintech company. There's so many opportunities to build a large business now in India. Just take your time. It's okay. Like market kahin bhaga nahi ja raha. It's like 6 months won't change anything.
Yeah. Absolutely. See, you've been one of the first really in e-commerce, and now the next level of e-commerce is Q-commerce, right? Quick commerce. Like I was telling you in our pre-briefing earlier, that in my apartment society, the local mom and pop shop is now putting ads which was unthinkable, 10, 15 years ago. They didn't need to put ads anytime because people were always buying from them. But now everybody is buying from quick commerce. You just order something. Yesterday I found something missing when I reached the hotel. I ordered it. It came in 10 minutes. How is that model? What do you make of this Q-commerce surge? Is it something that is sustainable? Is it going to go deeper? Is it going to really hit the kiranas, which we have been talking about for a long, long time?
Look, to me, as someone who's been building in e-commerce for more than a decade, it is actually deja vu.
Right, right.
When I see the rapid consumer adoption, I see all the advertising, I see all the media discourse, it reminds me of literally 10 years ago with the classic, e-commerce model that we follow. Even at that point in time, there was a lot of discussion about, is this the end of retail? Is this the end of this, end of that? Yeah. Nothing ended actually. Yeah. Right? Like they have somehow figured out a way to coexist. Consumers get a slightly different experience offline. They get a different experience online. The drivers of purchase are different. And offline retailers have also adapted over a period of time by enhancing their experience and assortment online, offline and online. I feel it's too early in the journey of quick commerce to, plant a flag either way, that this party won or that party lost. That said, maybe, in certain high density pockets, there may be some pain that kiranas must be facing, but I don't feel it is stress. I think that may be some pain. Now, I don't also think we have seen the last of how the quick commerce economics shape up. Okay. As an investor in many, many, many brands that are very successful on quick commerce and e-commerce in general, I can tell you the traction is phenomenal. There's no question about it. Right? Where many of our investee brands are doing anywhere from 20 to 50% of their revenues on quick commerce right now. That said, there is a perpetual push and pull that you see in terms of the economics between quick commerce companies and the brands. Eventually, this will settle. Some equilibrium point will need to be met where the economics will need to make sense for both parties for this to be a lasting, enduring business model for e-commerce. Right. We're not there right now. Right now, you're hearing about large burn rates, which are obviously not sustainable. So somewhere those burn rates will have to come down. Someone will have to pay for the increase in the economic viability of the model. And where the demand settles then will really determine what is the future of the offline and the online, like the Kirana model and the quick commerce model.
Right. It also, like you said, the cash burn, logically, if I look at it from a layman's perspective, the cash burn is supposed to be higher. If you're doing a Q-commerce model, you have to bring in more warehouses, more dark stores, more people to service, anywhere you're servicing, you'll have to get there in 10 minutes, which means phenomenal amount of back-end infrastructure has to be created. So what is the level of cash burn now in Q-commerce, and what is the path to profitability? Is there any hope of profits?
I think that you should, I don't run a quick commerce company and we are not investors in any of them. You should ask them, but at least from the outside, I think of quick commerce as just very, very, very similar to offline retail. Right? Where what are the levers that an offline retailer uses to grow their business? They launch new cities, they set up new stores, they have to be very specific about what assortment they will carry and what assortment they will not carry because they are space constrained.
Absolutely.
Right? And the fourth and very critical one is pricing. Because eventually there is very limited differentiation in selection. Because you're space constrained, more or less everyone ends up carrying very similar assortment unless it is largely a private label retailer. Yeah. But if you're a multi-brand retailer, largely if you look at in the offline space, there's limited differentiation in assortment. Then the differentiation is largely location, where you locked up some prime real estate before your competitor did, which doesn't seem to apply in quick commerce. Because if all you need is a dark store in a not so prime location, all your competitors can get it.
Yeah.
So the primary differentiation over time seems to have become price. And price is always a tricky differentiator.
Yeah.
And which is the point I was making earlier, that eventually there will have to be some equilibrium that reaches between the brands and how much margin they're willing to part with and the quick commerce companies in terms of how much subsidy they are willing to provide in order to become lasting, enduring companies, which I'm sure all of them want to become.
Right. Talking about profits, you have always been a very strong proponent of, startups building profitable businesses, right? It has to be strong business, growing business, profitable business. Like you said earlier, to my earlier question, think through what you're going to do. Don't just think over the weekend and all. Tell us a little more about this approach towards profitability.
Yeah, I think it's all from personal experience. I can tell you, like in the same group, we have two businesses. We have Snapdeal, where a lot of money was spent, partly also because this is pre-Jio, pre-4G,
right,
where we had only 100 million internet users and we had to kind of convince them to buy from us.
Yeah.
And so a lot of money was spent in the initial infrastructure, consumer behavior, marketing, discounts, etc. But it was a good learning experience for me. Now, obviously, we don't lose any money. We ship millions of orders a month. But while we operate in arguably the most competitive e-commerce market on the planet, for 9 years we've raised zero money, right? Which is an accomplishment in itself. But it was from a lot of learning and a lot of reflection. We also have another business in our another company in our business, which is called Unicommerce, which got listed last year.
Yeah.
That business never burnt any money, never has raised any primary capital. Even in the IPO, we didn't raise primary capital. Has been a cash-generating business from day one. So, having seen both the journeys, one business that required a lot of capital to get to this point, one that grew with internal accruals very organically, patiently. Personally, I prefer the latter. You're in more control of your destiny, you have less stress, you enjoy building the journey of company building, and you're less subject to the vacillations of the financing markets. The US rates, बढ़ा दी उन्होंने, तो suddenly the market collapses. You don't care. You just quietly build your own business.
Right.
So, and there's always been this obsession around unicorns, etc. So, and something I never liked, right? Like, or at least over a period of time, had grown to dislike, I should say. This concept of unicorns, $1 billion, 8,500 crores, and it's a valuation benchmark, it could be a zero revenue business and a unicorn, right? Or a massively loss-making business and a unicorn, or a subscale business and a unicorn. So I said we should counter a phrase with a phrase. So I came up with this phrase called Indicon, which is a 100 crore net revenue business as per the MCA filings, and profit making started in the last 15 years. Because I feel where our ecosystem is in India right now, we need thousands of these Indicons, not 500 unicorns. क्या करेंगे हम लोगों, मतलब valuations का क्या करेंगे? What we need is a strong bedrock of revenues and profits, and eventually these will grow into so-called unicorn valuations. That is an eventuality. It's rare to find a business that gets to 100 crore plus revenue profitably and then shuts down. But with unicorns, that tends to happen. Right? So inherently, it shows the fragility of assessing success basis valuations in private markets, that too, where one person has to say, I think you're worth this much.
Yeah, it reminds me of some of my editors who, who would always say, valuation itna hai, so what? That, that is notional. What is the money in the bank?
Also,
where's the cash?
See, in public markets, it's different, right? Like many thousands or tens of thousands or lakhs of people are in some ways deciding your valuation every day.
Right.
In private markets, one person decides. One person says, I think you're valued this much, done. Everyone believes you're valued that much.
That's true, that's true. So, we were talking about Q-commerce, and like I mentioned initially, you have invested through Titan Capital, you have invested in 280 plus startups across different areas like SaaS, health tech, consumer, everything. And now you were also talking about how AI is going to, is something that everybody will need to do. But what is the next big disruption that you see coming in the Indian startup ecosystem? Anything you have in mind?
I think outside of the obvious one, which is AI, and I spoke about it already, I can talk about one more, which I feel is, most people think that it's now done, and I feel it is just getting started, which is around brands. I feel India is highly, highly, highly underpenetrated when it comes to quality brands which speak to specific audiences in a highly authentic manner. So, if you meet a lot of investors right now, they'll be like, oh, the new brands, the D2C brand stories over in India. I personally feel it is just getting started. Because when I travel the country and I meet consumers, I go to their houses, go to their kitchens, I go to their bathrooms also just to check what are they using.
Yeah.
I open their cupboards, open their fridges. And the level of acceptance they have to brands that have never advertised on TV, don't have brand ambassadors, is outstanding, is incredible. So there is an inherent trust that has crept in amongst the Indian consumer with new age brands. And these new age brands are going to give a real fight to the traditional brands.
Yeah.
And tremendous amount of value is going to get created on a going forward basis by these new age brands.
You mean the startup brands? There have also been the regional brands that have always given the top brands a run for their money, whether you talk about FMCG or any of the other categories, right? There are, like you said, there is acceptance of a lot of smaller regional local brands that are really not known outside their sphere of influence.
Yeah, the other thing, if you want a third idea given,
Sure. We love more ideas. We love more and more ideas.
Yeah, maybe more entrepreneurship will get precipitated. I feel that there is a market structure that has changed. Earlier, people used to say that Indians don't pay for content. Right? As a media company, I'm sure you would have said that to a few people too.
Yeah.
I feel that has changed.
Okay.
Now, consumers have started paying for content, just the right content in the right bite sizes with the right amount of money. Because with the ubiquity of smartphones, ubiquity of UPI, and a general sense of familiarity with consumption, like now at 25, 30 GB per month per user, there is a habituation of consuming content. And with growing affluence, people have stopped caring a little bit too much about 10 rupees, 5 rupees, 15 rupees. So the next generation of media, content, businesses will be created by collecting these 5 rupees, 10 rupees, 1 rupees, 12 rupees. And those will create very large businesses also in India in the future.
Okay. It's a very interesting thing that I noticed that you are also an independent director on the board of Piramal Enterprises. And coincidentally, Ajay Piramal and Nandani are going to be here, in less than an hour from now. What does it mean to you, right? You are this star, entrepreneur. You've seen it, been there, done that. You've done everything that you could. You're still investing, doing a lot. But being on the board of a legacy organization, how does it help you and how does it help them?
Given if they are coming, you should ask them how it's helping.
We'll ask them for sure.
Hopefully, they say something nice. But we had a board meeting today only. But look, I feel over a period of time, it became clear to me that eventually the purpose of building a business should be to, ideally, if you can, the business has the strength and you have the ability and the resilience, the purpose of a business is to take it public. So that, that's when it becomes a lasting, enduring company with many shareholders in the public eye and the scrutiny. So it has to always uphold a high standard. Somewhere along the journey of my entrepreneurship over the last 18 years or so, I realized that at the end of the day, that's what I want to do with my businesses. I want to take them public eventually. Right? And last year we successfully were able to take one of our businesses public, and it was very successful. It was the second most subscribed IPO of 2024. It was oversubscribed 170 times. Maybe a bit of the sign of the times, but it continues to trade over IPO price despite the market meltdown, so I'm happy. But I felt there's no better way to learn how to run a public company, how to conduct myself as a promoter of a public company than being on the other side. Right. On the board. Because that's the only way you can truly empathize the challenges that someone who's a custodian of the shareholders' interests, which is the independent director, only then can you truly appreciate that what an independent director goes through, so that when I have my promoter hat on, my operator hat on, I can do right by them, right by the shareholders. It was hugely beneficial. That's why I got in. Over a period of time, I learned so much more. Right? Okay. Like you always get into something because you have a certain thought, but usually you get surprised by other things that you learn in the process. Right. It's been a phenomenal experience for me just being in the company of such stalwarts, right? Mr. Piramal included, and other luminary directors, late Mr. Wagul, Mr. Ramadurai. I was the youngest person, I still am the youngest person on the board, and I think it speaks to his greatness, his foresight, his vision to want someone like me on their board, that maybe he thinks that I can add some value. I'm just completing my 5 years right now, this year on the board, and it's been a fantastic learning opportunity, and I'm very grateful to him.
So tell us, if you put on your hat of an independent director, as opposed to Kunal Bell, the star entrepreneur and the promoter, what are two challenges that independent directors face that when you put on your promoter hat on, you are going to be cognizant of?
Yeah, I think one of our directors, who I really look up to, Mr. Akhil Gupta from Bharti, who's vice chairman of Bharti, who's really, he's my mentor. Pretty much everything I've learned about business, I've learned from him. So I'm, perennially grateful to him. He's been on our board for over 12 years now. And, there oftentimes founders, new age founders, younger founders always feel that there's an adversarial relationship you need to have, or you will have an adversarial relationship with your investor directors or independent directors, that somehow they are not on your team, so they're on the other team. But that is not the case. They are actually there to protect you from yourself more than anything else. They are aligned with you. They want you to do the right thing always. And sometimes founders, operators can get overzealous, right? Not out of ill will or wanting to do something wrong, but just get, overexcited about an opportunity. And you need that voice of reason in the room to tell that, have you thought about everything? Have you thought about X, Y, Z? This is something we've tried before. It didn't work out for us. Why would it work out this time? You want a well-wisher in the room who has a fiduciary responsibility to the shareholders, but at the same time wants you to succeed, right? Really wants you to succeed. So I learned many valuable lessons. I asked Mr. Vagul when I was getting on the Piramal Enterprises board that what advice you have for me. And he's arguably one of the incredible individuals, great Indians, I would say. And he said that always focus on listening in a board meeting, and if you have a lot of comments, send them later on. So that's at least the philosophy I follow.
Okay, thank you. The alarm has rung and our time is up. We will try for a question from the audience. Is there a question? I got so many questions. We won't have time for so many of them. The gentleman in the front. Oh, you already have the mic. Okay. You go for it. After that, you take it from him. Short question, please. Don't give a long statement.
So, I will start with the Shark Tank because we have seen you and followed you, and we have seen the closure of the deals also. And you are so focused, and you generally try to take the higher equity than the other sharks. But we have seen you have invested already in more than 250 startups. So my question is, how do you manage the after investment, the due diligence and the portfolio management? Because handling this many startups,
it's not easy.
Yeah,
yes.
It's a good question. It's a good question. Thanks for asking that. Just to be clear, these 280 odd startups, we invested over 15 years. So it's not like we started last year or 2 years ago and then invested in 100 startups per year. We have an average run rate of 15, 20 companies that we'll invest every year, which actually comes out to maybe 1.5 companies a month or 1 company a month, which is actually not that much. So at least at Titan Capital, we have very high bar, and we've been very blessed as a result to partner with really great founders, and the results automatically followed in terms of the portfolio. But the credit goes to the founders. I think the really good question you asked was what role do we play after we've invested? Because I can tell you the same mistakes I made and same mistakes I've made other founders make, I've seen other founders make. Every founder, however smart, well-read, well-intentioned, humble they are, they want to make the same mistake again and again. And usually those mistakes are spending too much money too soon, hiring too many people too soon, having too many passion projects going on in the company, worrying too much about competition, not giving enough regard for regulation. It's the same mistakes everyone makes. And at least my job in the early days, because we do very early stage investing, seed, pre-seed investing, usually the first or second check into the company, is to ensure that we allow we don't make the company go through mortality because of these cardinal errors that entrepreneurs, dozens or hundreds of entrepreneurs before them have made. And how we do that is we meet when we invest in a company for the first 6 months, we will meet them every month, thereafter every 2 months, and thereafter a steady state cadence of 4 times a year, so every quarter. But each of the companies has to send their monthly MIS by the 20th of the next month. And the single biggest value add I think we make, I can talk about reams upon reams about, oh, we add this value, we add that value. I can tell you the single biggest value we add is the discipline around maintaining an MIS and sending it to your investors. That actually automatically shows the mirror to the team to the operating team every month, and it ensures that whatever is going wrong, they fix it quickly.
Awesome. Thank you for the question. Last question.
Okay. Good to see the shark and real. I'm Pankaj Jain, representing Pro Growth Ventures. I have an out-of-box question, taking you back to your Snapdeal days. I want to know, curious to know the story behind Snapdeal Nagar. How did that happen? And was it deliberate? Was it a strategy? And what was the impact?
Yeah, I think it's funny you mention it because it's been many years anyone's asked me that question, given this is now 12, 13 years ago. Just quickly, I know you're out of time, but one of our colleagues, this is now maybe 13 years ago or so, one of our colleagues in the office, his wife was from a very small village outside, I think, Panipat in Haryana. And apparently they had the children were not going to school. So why the children were not going to school was that the mothers had to go walk 5 kilometers or 3 or 5 kilometers to fetch water in the morning. And so they could not leave the kids at home, so the kids would go with them. And then they would start playing in the water, they would never go to school. And it's very sad, but true. So we said, can we do something as simple as putting water hand pumps? They costed like about 1 lakh, back then 50,000 rupees each. We just put I think 10 or 12 water hand pumps. And in appreciation of that, the village elders decided to rename the town, the village Snapdeal Nagar. So that was about 12, 13 years ago. But that was really the background.
So you've left as much of a stamp on the rest of the startup ecosystem as you've done on Snapdeal Nagar. Kunal Bell, thank you very much for coming and spending time with us.
Thank you so much, Kunal. Alokesh, please present a token of our gratitude to Kunal. An absolutely engaging and insightful conversation. Thank you once again, Kunal, for making it to the Mint India Investment Summit. Thank you. Stay glued to your seats, everyone, because old school values meet new age velocity as our next speaker navigates the corridor of one of India's most iconic conglomerates, RPG Group. This in an age where legacy is both a gift and a GPS. Is leadership different when you're inheriting not just wealth, but even values? Let's find out. Let's invite Anant Goenka, Vice Chairman, RPG Group, who will be in conversation with Ranjini Raghavan, Editor, Mint. Welcome. Welcome, Mr. Goenka.
Hi. So after that enriching session on the startup ecosystem, we'll move on to how large conglomerates operate and what it takes to lead such a conglomerate. A very quick introduction on Anant. Since the RPG Group was formally set up, he's from the 3rd generation. But of course, the Goenkas have been in business for over seven generations. RPG Group turnover over 4.4 billion, and Mr. Goenka here himself is the vice chairman of the group, as well as of 2 entities, CEAT and Zensar. And the interesting thing is, after Anant Goenka took over at CEAT, the company saw its market cap expand from about 50 to 60 million to over $1 billion, 1.2 billion in fact. So we'll talk a little bit about how that came about and a little bit about how leadership decisions impact decision making, so to speak. So, and I actually want to start from the beginning. Your first job was at HUL, and then you took not entry-level jobs, so to speak, at CEAT and Zensar, or KEC, I think KEC. So how did that come about? What was the thinking, and how did you graduate from there into a leadership role?
Yeah, so I think we looked at my role as, I thought of working in areas where I could really build my skills right in the beginning. And I think there was no better training ground opportunity than HUL that I got. I looked at various other options. I thought of consulting, I thought of banking, I thought of companies like HUL, and then HUL worked out, and I think it was maybe an excellent opportunity for me. I was a business leadership trainee there initially. We spent about 3 months. We had to spend about 3 months in different roles. And I would say spent 3 months in the factory working night shifts, spent another 3 months in rural India implementing Project Shakti and other sales opportunities in various villages around Madhya Pradesh. And then I worked in Lakme Beauty Salon for some time and so on. So various different roles, lots of different challenges. And I think it really helped me understanding, getting out of the protective shell that many of us are brought up in, and understanding a lot of the real India. Understanding that India is made more than just one homogeneous body, but each state is so different in its own way. How people are really living on the ground in terms of the lives of a territory leader, the life of the person on the shop floor, working night shifts and so on and so forth. So I think that is what I really found very useful. Then when I joined CEAT, I joined as territory leader sales, moved on to a regional manager role where I looked at areas such as Jalgaon, Talegaon and different areas, and then grew to a larger role of looking at a smaller SBU, moved to a head of supply chain in KEC, and then eventually deputy MD and MD of CEAT in about 10, 12 years' time.
Yeah, yeah. And what kind of mentorship did you receive, especially from your family? Were you groomed for these roles, or other, mentors that you can think of?
Yeah, I think as a result of so much change, I had many bosses. So I'd say each boss was a mentor for me, whether it was the managing director of CEAT, Paras Chaudhary at some point of time, or the leader in KEC. He was a great mentor. I'd say at each role, I learned, the best learning was by doing. The fact that you had a chance to do so many roles, I think I saw so many different types of leaders, some that were very empowering, some that really got into micro details. And I think each and every experience was deep learning. But to me, I'd say one area which made a big difference, or one challenge that I really faced, was one of confidence all through this journey. Because at every change that I had within the group, a lot of it happened because I was part of the family. So I was territory leader for about a year's time. Then in another year, I was a regional manager, and another year, I was heading a small SBU, and so on. That would not be a normal trajectory of a non-family member. You spend 3 years at least maybe in a role or so. So I think to that extent, what helped was I learned a lot, but I think where I lost out was a little bit on confidence, because I knew I was growing because of being a part of the family. And I think that stayed with me nearly for about 12, 13 years. I started my career in 2003. I'd say I really got confidence in myself about 12, 13 years later, after I saw good success in CEAT. Till then, I was always doubting myself. I would have people who were far more senior than me reporting into me. I would have the head of R&D, head of marketing, 20 years, 30 years experience. If they disagreed with me, I would always doubt who is right, because I'm this kid with, as an MD at 32, 33, and you have a 50-year-old who has so many years. So how do you balance that? And I'd say one mentor or one leader I had was one of my Kellogg professors, who kind of said two things. One is largely, he just said, everything is common sense. Common sense is a little less common. This is a well-known statement, but I think it was just something simple that stuck with me. And the second was kind of just do the right thing. Sometimes you'll get a lot of noises, a lot of views, different perspectives. But as long as you're doing the right thing, it's okay. You may be wrong. So I kind of looked at those couple of simple messages as my guiding lights and tried to do as much as I could the right thing. But I'd say the confidence aspect came only at a much later stage.
And that's a very insightful thing, because most of us suffer from bouts of lack of confidence from time to time. Specifically, would you say there are certain coping mechanisms that people should, how do you mentor your team members, for instance, on how to overcome that, maybe bout of lack of confidence while doing something?
I can share with you one example of mine. I'd say that one of the biggest fears that I had in my life was public speaking. I would hate going up and speaking, to the point that I nearly didn't want to take up the role of managing directorship, because I knew I would have to do town halls, speak to investors in groups and so on. And I was like, I used to have that kind of fear where you'd rather die than go up on stage. So that with that kind of fear, I was like, I just don't want to do this. And I know that I had become deputy MD of the company, and we were having a town hall. The MD was there, he was going to speak. I was pretty chill because I knew I didn't have to do anything. And then at 12 o'clock, the town hall was at 2. I had just joined a few months ago from KEC to CEAT. And at 12 o'clock, he says, I'm not feeling well, I'm going home. You're the next in line as deputy MD. Why don't you come up and speak? And I'd say my heart sank. I was like, my worst nightmare has come true. And I had to come up on stage. I tried my best. But I think at the end of it, I felt, okay, it was not as bad as I thought. And I think it was just peeling of the onion. The next time, I would keep trying. I would by heart speeches sometimes. I would find different ways of speaking. I went through training myself. So it was those practices that kind of gave me confidence over time. And then it became a part of routine, because I had to do it now. Maybe once in a few weeks, I would speak up, and it became part of life.
And now you're an expert, pretty much. If we can move on to, your CEAT years. When you took over, the company was at a certain stage, and then, in over 10 years, you sort of expanded. The market cap growth is like for everyone to see. What were the specific changes in strategy that you undertook at CEAT to enable that?
Yeah, I'd say CEAT had gone through a fairly difficult time in the early 2000s, and my predecessor did a great job in making sure that it moved from nearly a point of non-survival to one of survival. When I joined CEAT, I still found a number of challenges and areas where we could take it to the next level. And I found a few things. One was our debt equity was still 2:1, which means we didn't have money to further invest in the company in anything big that we wanted. Second, when I spoke to customers, investors, they said, okay, you have a good brand, decent distribution, but what really differentiates CEAT? It's a tire company. Consumers, many of them don't even know what tire they use. So what's your story? How will you differentiate yourself? And we didn't have a clear answer on that. I'd say we also didn't have a clear vision for the company. When I went and asked people, what is our goal for the next 5 years? They would say our budget is to grow by 10% next year, but there's no long-term goal. And when I found something, it was like, okay, increase value for all stakeholders and shareholders and customers, but it was so generic that nobody knew some of that. So we got a group of about 100 people in the company together. We created our vision. We thought about how will we differentiate ourselves, and we said, let's look at winning in one category of tires. We are there in two-wheelers, passenger car, truck, and all of that. We were ranked 4th in the industry out of 5 players, and we were 4th, 5th, 6th, kind of in nearly all categories. So we weren't winning anywhere. So we said, let's look at winning in two-wheeler segment. That's an area we find that we have potential to win in, and we decided to focus on that. We again went to the customer and asked, what is your biggest need? And they said, grip on the road. Road pe pakad acha hona chahiye. And based on that, we decided to launch a new range of tires. We called it CEAT Grip in a way, and that was simple. We also, through insighting, found that customers, that everyone felt they were a good driver, but people in India are not good drivers generally. And they said, we came out with this campaign called the Idiot Safe campaign, which said that the road is full of idiots. use CEAT tires for good grip to protect yourselves, because two-wheeler, you can have a fatality if there's accident. So that clicked with the customer in some way. And the biggest change we made was on distribution. So again, a salesman's behavior is a lot on the value that he sells. A truck tire, for example, is 20,000 rupees a tire. You have 10 tires per truck and multiple trucks with one owner. So the ability to sell truck tires and realize your value is much higher, whereas a two-wheeler, you have to sell in rural India. A small mechanic may buy 3 tires per month or 10 tires per month, much lower value. So we had to change our entire distribution network, and we found that if companies like HUL can sell a 2 rupee sachet in the smallest of villages, why can't we sell a 2,000 rupee tire? And that's where we looked at building out our distribution. It was a very long, nearly 4-5 year journey. And we moved from about 3,000-4,000 sales touch points to about now 30,000 touch points in two-wheelers. So that put us far ahead of competition, and we were able to gain market share. The biggest change that we made was a lot on culture, I would say. And that we learned from the concept of total quality management. So some of us leaders went to Japan in the early years, I'd say around 2010, and we found that we are not possibly running in the best way. Our factories were not in a great state. Trust between workers and management was not great. We were firefighting all the time. Financials were not great. And when we went to Japan, we found companies like Sony, Toyota, Denso, Hino Motors, and we were like, wow, these factories are just absolutely incredible. We learned a lot from them. We spent about 10 days there, in few days in the classroom, few days factory visits, came back, and we decided to adopt TQM as our way of doing business. And that is what defines, I'd say, the culture in CEAT today. TQM was something that was adopted by a lot of the Japanese companies post-World War II, when it was when Japan was in shambles. Some of these leaders like Edward Deming, the Toyota founders, etc., came up with a way of doing business which says business results are very important. Customer is at the heart of doing business. You exist and invent for the customers. Systems and processes are extremely critical to achieving these goals that you're looking at and customer satisfaction. And fourth, people capability building through total employee involvement in improvement activities and problem solving are key. So these are 4 kind of principles that we looked at adopting, which I'd say defines the culture and values of CEAT. I'd say the strategies can undergo change, but the culture is something which we strongly believe in. Today, if there's any doubt in anyone's mind that, okay, I'm going to lose profit here, but the customer is going to be happy, people will veer towards customer happiness in CEAT. So I think those were some changes that we made, which resulted in, I'd say, a market share improvement from about 10 to 30% in the two-wheeler space. We were ranked #1 by JD Power in customer satisfaction amongst other tire players. We also adopted digital in a big way, which resulted in us getting a World Economic Forum recognition for lighthouse factories. And our ranking globally, we were the largest shift in ranking from being the 30th largest tire manufacturer to about 18 over this period. So we saw a substantial shift because largely I would attribute it to the culture change in the company.
Right, right. How long do you think that culture change took once you started implementing it?
It took us about 7-8 years' time.
Okay.
Yeah, it was a long journey, a lot of doubt, a lot of questions that were being asked. How long will this flavor, how long will this initiative last? Maybe we'll go back to our old ways of working. So I think those were...
And was it a straight up curve or...
No, not at all. It was up, down, up, down. I think the good thing was that there was a consistency in the leadership. And all the leaders that have been there, they have been there for the last, I'd say minimum 8-10 years time. And that made a big difference as well. So there were a lot of doubts, a lot of questions, a lot of shifts that we had to do in our own understanding, because this concept is pretty vague at some level. But we had to be very clear, what does it mean to us?
Yeah. CEAT has also, and as part of the RPG group, you've been investing in startups as well. Can you talk us through whether this kind of a investment required a shift in thinking? How did that come about?
Right, so we felt that startups operate at their own pace, and there's a lot to learn from founders, from startup owners, and we said let's look at investing. Our capital investment allocation philosophy would be saying about investing 70% capital in the core of our business, 20% in adjacent areas, and 10% in high risk, high return kind of areas. So through that, we said, out of this high risk capital allocation, let's look at some startups. We found one area of a big customer problem is that the experience of fitting tires is not fun for any customer. You have to go to a dealer shop, wait for an hour, not a great experience out there. So how do we change that? So we invested in a company called Tires and More, where a van comes to your home, supplies you the new tire, does the change for you, and goes back. All you have to do is send the keys downstairs, and they'll take a photograph and give it back. So that's one that we've invested in. I'd say the second is on, we have a large base of fleets who are our customers, and the biggest issue that they face on a cost side is fuel cost. So we worked on, with sensor prices having come down, can we put in sensors in the fleets and look at providing them with data on driver behavior, on maintenance of their fleets, etc., to bring down the fuel cost. So these are some, I would still call experiments that we are undergoing. I'd still not say that they are all very successful, but we think we are learning a lot through the process.
How's the climate venture doing? That's also a focus area for, I mean, the future focus area, I would say.
Right. So as an unrelated business that we got into was carbon credit business. So we feel that one of the mega trends, again, is on climate, and there will be always large MNCs in the US and over time other parts of the world looking at net zero targets. A large part will be able to be done by themselves through moving towards renewable energy, efficiency, etc. But some amount they will need carbon credits for the balance. In India and developed world areas, we have enough projects and good work that is happening, and we can do more good work against which you can get more carbon financing. So that's the basic philosophy that we have started off with. It's a very early stage investment or startup that we're doing, and the market is still very, very early. So the result is still to be seen.
Yeah. I wanted to move on to something, which all of us as leaders have to do, which is sort of take difficult decisions, have difficult conversations. Do you have like some thoughts on how you go about these decisions?
I think, again, as you say, it's a little bit of just practice, I would say. Initially, there's a lot of hesitation. How do you fire somebody, for example? Yeah. How do you take decisions on giving feedback? And I think there it is as much about the feedback receiver and giver, for example, on how do you manage that. So I think preparing in advance when you don't have the feedback time, just kind of appreciating the fact that feedback is a gift to you, being open to taking that feedback as well, I think that makes a big difference. To give you an example, what I do is I spend about 45 minutes with each of my direct reports, subordinates, team members, and kind of just say that what's going well, what can I do better. I summarize that and I send them an email, kind of just saying these are the goods, these are the areas of improvement, and these are the things that I'll work on. And I think the idea is that it's just to get them also to appreciate and kind of say that we can work on some of that. So I'd say it's, again, initially I was very hesitant as well. There was always some defensiveness in taking feedback, but I think as you practice, you get better.
Better at it, yeah. I was wondering if you had any leadership philosophy. You mentioned the TQM framework, but in terms of your values, would you say you're fairly collaborative as a leader, or do you have a different style?
I think fundamentally, people are good and they come with good intentions. So I think I believe in giving them a lot of freedom in what they do. I'd say that at the position I am, I have a few CEOs that report into me. So in a way, they're all very intelligent, and I don't think there's too much interference. My goal is to get out of their way, help them take out obstacles, and do some amount of selling for them. In terms of, at my position, I'll have access to customers in some way, which they may not have access to. So I spend some time on that. But I think values is very, very important to me personally, and I spend a lot of time on that. So I shared with you a little bit about TQM and CET's belief systems, but I'd say at a group level, we've defined our values to be unleash talent, touch lives, outperform, and be happy. So within those value systems, we think a lot about how are we living that. On Unleash Talent, are we the number one place where people are happy working, for example? Second is diversity. Do we have enough gender diversity, and over time, other kinds of diversity as well? So we've defined these into clear metrics, saying that what does Unleash Talent mean for us? What does touch lives mean for us? Are we number one in customer satisfaction, for example? Touching lives would also mean, are we doing right for the environment? Are we purpose-led? And Outperform, we have metrics of ROC,
how would you
market capitalization and business excellence. So these are, say, 6 or 7 metrics that I look at measuring. To drive that change in values, I would say I use a 4-point checklist. One is, am I role modeling the behavior that I want to see in the people? Second is, are we communicating the change that we want to see? Are people very clear and understand that change that they want to see? The third is, have we put it in the right systems and processes of the organization in terms of reward and recognition systems, penal systems, performance management systems, etc. And do we have the right talent and capability building that is there to see that change that we want to see?
I was interested in the 4th point, the be happy point. How do you assess the being happy of it?
Right. I think it comes in through a lot of storytelling in some way, sharing stories of what is happening in the organization, actually trying to behave in that way. And by happy, it's not just the happiness that you get on the surface by having an ice cream, but it's more about work-life balance, actually making sure that people are living a life of purpose. We're taking care of families. Families are happier at some way. Are they feeling valued? Are we investing enough in their learning and growth, for example? Are we giving them freedom to work the way they want to work, and so on? So I think happiness is more felt in the smell of the place when you go there. I'd say out of all the people who leave us, nearly about 50% people want to come back after some time. So I think that share is fairly high. And measurement is done. We do have a survey that we have a happiness survey where we see a score and we work towards improving and getting feedback on that.
Right. I mean, you mentioned work-life balance. What is the ideal approach? Like, we've had a lot of leaders say that they'd want employees to work 70 to 90 hours. What has your outlook been towards that?
I think each person has their own style in some way. And one thing which a professor taught me in college, which I think is useful, is he said, break up your life into 5 parts. One is family, health, work, friends, and maybe spirituality and giving back. Put a percentage on what is important to you. And put an actual percentage on how much time are you giving to these 5 activities. And you'll realize that there are some gaps in terms of what your aspiration is and what you're actually living. And through that reflection process, can you keep tweaking that change? And you can keep thinking about it every 5 years. Your preferences change, your own desires change, and everyone has their own way. So I found that to be pretty effective in terms of how I practice it. But I think it comes in also in a lot of micro habits that we have as people. For example, for me, having some alone time to think is very important. So I make sure that the first 1 hour of every day, I'm spending time alone, whether it's reading, thinking of planning the day, catching up on some pre-reads for meetings, etc. So that's one practice, for example. The other is trying to just get your workout done in the morning so that you're clear that you've done that activity. Family time, making sure I'm taking my holidays, weekends off, and so on and so forth. So I think it's about just having those micro habits of day-to-day management that you can plug in to your daily life. For example, I carry a change to work, and if I feel I've not done my morning workout, I jog home, because it takes 40 minutes by car or 40 minutes by jogging to go home.
Because of the traffic.
Coastal road. Yeah. So to that extent, you find your own ways to practice.
But I mean, this is some would say, a very liberal way that you're advocating for your employees in terms of work-life balance. Do you sometimes get pushback from investors? Because the whole culture that we've built, the whole capitalism culture, is to sort of eke out as many hours, as we've seen in some public comments made by senior leaders of conglomerates. Is there a tension there in terms of whether you're, in terms of return on capital or in terms of how much value you provide investors?
Right. I think one thing we did think about some amount is that does success lead to happiness, or does happiness lead to success? And I think we found that successes often lead to short-term happiness. But if you can think about happiness as your way of life, success comes more easily to that extent. So I think we feel that happiness leads to more success. If you're happy or your people are happy, customers will be happy, attrition is lower, and those are the benefits. And I don't think it means that you have a free ride, that I want to spend 80% of time at home and so you're doing well. You have to it will affect your growth, it will affect your promotion if you're not delivering on the results. So in the end, your results are very important and you can't survive in the company if you're not performing.
Yeah. We're actually at the end of our session, but I was wondering if you had any advice you would want to give young entrepreneurs who are setting out to build something and on how they should lead their business or their teams.
I'd say that one is think about working in your area of or zone of discomfort. I found that I did a lot of roles. I worked at Morgan Stanley, for example, in Hong Kong for some time. I did banking. And I found that I absolutely hated it. So I think to that extent, not the company, but I'd say doing banking was not particularly exciting for me. And I think it was a new geography for me. I didn't know the language. I found that the people there, in the city, were not so friendly generally. So those were challenges that I faced, and I learned out of that. I also found that I worked at HUL, and I found it very fulfilling, but I experimented marketing, manufacturing, HR, and I was able to figure out my own areas of strengths and focus areas. So I think really going through some amount of the grind, going through and working in areas of discomfort makes a big difference. I'd also say young people who start up are actually time billionaires. If you look at in seconds, 1 billion seconds is about 31 years. So you are a time billionaire when you start off at maybe the age of 20 or 25. You have a good 30, 40 years to go in terms of your work experience. So at least, appreciate that. And I think that any money billionaire would give up their money for being a time billionaire. So appreciate that fact and look at that. I'd say also appreciate our next generations. I think our previous generations. I think there's a lot of wisdom that comes in from our parents, grandparents, and I think there's a lot to keep learning and thinking and imbibing from that and taking that forward rather than coming in and making change. You have a lot of time, so think big, think long term. I would just say these are some things that...
Wonderful concepts. Can I invite questions from the audience for Sneha from Mint?
Hi, Anand. Sneha from Mint. It's interesting that you spoke about this entire thing about self-doubt and, a period of, where you really, lack of confidence, affected you. And you spoke about the mentors also, but an entrepreneur's life is very lonely in that sense. So who are your sounding board? Who do you go to speak your mind out and, when you have doubts? Because often when you go back to your team, they're looking for answers, but who do you look up to for answers?
No, I'd say I have a lot of people who I go to. I have a group of friends who are CEOs, and we are kind of a personal board for each other. So I think that is one group that I go to quite often. I'd say our board in our respective companies, or for me when I was in CEAT, I would easily call any of our board members and ask them, I'm stuck in this, I'm doubtful about this decision, or I need to vent about something, and they would hear me out very peacefully. My father, I speak to him a lot about doubts that I have, that, okay, what do you think? Is this right, wrong? So he gives me, so I think I have luck of a lot of leaders. I also go to my team members. So they're all smarter than me, so I'm very happy to go to any of them and say, what do you think? How do I manage this? What would you do?
Can we take that question?
Hi, this is Maulik. Yeah. So there are tough times when markets don't grow as expected, and probably tough calls have to be taken. So sometimes, it's good to amputate rather than letting the body die.
Could you speak a little loudly? I can't hear.
Sure. So there are tough times when businesses don't grow as required. Sometimes it's good to amputate a part of the body than letting the body die, right? So that means that sometimes we may have to lay off people. What's your take on it? And what advice do you give in tough situations like this when we have to lay off?
So I'd say laying off people would be possibly the last thing that we would do. So we would cut all other kinds of costs, find all other solutions for growth, and then you look at laying off as an option. Fortunately, in my period, I've not had to go through any round of layoffs at that time. But what I understand is it's best to do it in a very short period of time and quickly. So you take a decision if you have to lay off a certain number of people, do it in a period of 24 hours, make an announcement after that saying that, okay, we've had one round of layoffs, it's very unfortunate. Give them all the support you need for that period of time where they may not have jobs, and give them a long handshake in some way so that they have that time and you're humane and compassionate about it. But then at least to avoid the shake-up of the organization, because people will be thinking that my turn is going to come next, you communicate very effectively and tell them that this is the end, we've had a round and that's where it ends.
We'll conclude here because we're really out of time. Anant, really wonderful conversation. Thanks so much for your time. Thanks for coming here.
Thank you, Ranjini. Yeah. Great to be here. Thank you.
Sure. Thank you so much, Ranjini. Ranjini, kindly present a token of our gratitude to Mr. Goenka. And ladies and gentlemen, I think this conversation calls for a bigger round of applause, everybody. Straight from the heart, let's show a lot of love. And stay glued to your seats because our next conversation is one you don't want to miss. What's the perfect succession plan? It's not just about handing over the keys to the corner office. It is about passing on passion, perspective, and most importantly, a purpose. From healthcare to finance, from resilience to reinvention, this is a conversation between two generations of leadership at Piramal Group as they talk transition, trust, and tomorrow. Time to invite on stage our speakers, Ajay Piramal, Chairman Piramal Enterprise, and Nandini Piramal, Chairperson Piramal Pharma, who will be in conversation with Sneha Shah, Deputy Editor, Mint. Let's welcome them with a very warm round of applause.
Thank you, Mr. Piramal and Nandini, for agreeing to do this. We couldn't have asked for a better family, who could, because they have the legacy of having built large enterprises, and now it is being passed on to the next generation. So the best father-daughter duo in India Inc. is here with us, guys. Please, let's have a huge round of applause for them. Mr. Piramal, you've built Piramal Enterprises from scratch. What lessons did you learn, along the way? And how have you passed on those lessons to, your children, especially Nandini? And Nandini, if you could go next and talk about how you've applied those lessons, in running those enterprises.
I think all the businesses that we've had, there is a purpose which we all talk about within the organization, which we talk to all the people, and that is that doing well and doing good and making a positive difference to the world around us by living our values. I think that is important for us, the purpose behind it, why we are in business. And so our belief is that a business has to do well and it has to, in other words, it has to do well on financial metrics. But not only that, it also has to do good to the world so that the world is in whatever area we are in, we leave something better than what we came in it. And that's what we measure, both doing well and doing good, and by living our values. So I think that is perhaps the most important lesson. Talking about, and this is as relevant to us in our business as it is in our philanthropy. Because philanthropy also, yes, everybody does. You are doing well, let's take that. But you should also do good. So we measure both impact of the philanthropy as well as what we are doing. Similarly, I think the next is that it is on values. What are the values that are important to us? I think one amongst, we have actually again laid out values and our people are aware of it, but the best thing is to put it into practice. So one is integrity. What do we define by integrity? It is what you think, you say, and what you say, you do. So there's alignment between thought, speech, and action. And one more thing I'll highlight as far as values is concerned is the concept of trusteeship. Trusteeship means that we are just trustees, or that there is certain wealth, or there is certain, who's a trustee? Person who has been given some wealth in a trust, or whether it's a business, whatever is in a trust, for the benefit of the beneficiaries. And who are our beneficiaries? Our beneficiaries are our customers, our employees, our shareholders, as well as society. So everything we do as trustees to ensure that we work to the maximum long-term benefit of all these stakeholders. I think these are some of the values. One more last value is to always have the courage as a leader to travel the road less traveled, to go on that road. So the ability or the courage to take risks, yes, you may be wrong sometimes, but it's that's what makes ultimately the difference.
Nandini?
I think just following on from that, I think I fundamentally believe that the values create value. And it is incredibly important that they're not just words on the wall. I think there's a famous professor, Professor Sumantra Ghosal, who actually had this interview. He's like, culture is about the smell of the place. It's when you walk in to an office or into a meeting, how do people treat each other? How do you make those values come to life? And one example, in a way, is when we talk about integrity. In pharma companies, you'll see, you'll have seen a lot of headlines of data integrity. What does it mean? Ideally, the regulator should know, and your patients should know, that the data is the data. It was kind of put in and entered in when it was said it was entered in by who the person is. And for us, that's an epitome of integrity, which means that the data does what it says it does. And as a result of that, our quality record is pretty amazing, because we have probably hundreds of customer audits, double-digit, at least 40 to 50 regulator audits across our plants, and we've never had a warning letter from the FDA. And I think that's a record that we stand by, and it's because of the intent and the values, and I think that creates value.
Right. Also, the landscape has really changed from when Mr. Piramal started, because, they were the OG entrepreneurs, they were category creators. But it is very different for someone like you, Nandini, where, today the challenges are very, very different. The incumbents are being challenged by newer entrants. So, with that changing landscape, how has the, entire approach to, leading the business changed?
So I think when you were building a business in the 80s and 90s, it was more of a closed economy and more of a license Raj. I think that has changed. It is easier to do business in India, but we're also more global. So for example, we have factories and manufacturing in the US, the UK, as well as India. So, we're running on pretty much a 24-hour clock. And so that means it changes how you do business, it changes who you interact with, and it changes who your customers are. And you as an organization have to adapt. So for example, a lot of our customers come to our plants and they would expect the line engineer to be speaking perfect English. So, that's the kind of conversations that they want to have. And you think, 30 years ago, they wouldn't be speaking English in the factory, just as a small example.
Right. And Mr. Piramal, how do people of your generation went through different kind of struggles? How do you reinvent yourself as an entrepreneur? Because every decade the landscape is changing. What have your learnings been, and how are you trying to reinvent yourself?
So really, the way I try to reinvent myself is meeting people, different types of people, both in India and abroad. Fortunately, I have the benefit of meeting very smart people. It's not only smart, that intellectually smart or who have a very high IQ, but people who understand what businesses are like, what's happening globally. So that is one way of really keeping in touch with what is happening. We also have many relationships with partners in India, with partners abroad. You meet them. I think to me that is there. I also do a bit of reading, not as much as I should, but yes, that is another way. And attending some conferences, whether it's the World Economic Forum or a few others. I think that's the way to just keep reinventing, because one thing is true, that things are changing a lot. So in all this change, what I think remains constant is the values. They are like the really North Star that doesn't change. And I think once you keep that in mind, it just helps.
Right. Before your session, we spoke to Anant about leadership style, and I'm sure the audience is also curious to know what your leadership style is perceived as more strategic and more visionary. That's how we perceive it, and Nandini is perceived as more innovative and trying to do newer things. How do you really there is matching of minds when it comes to running the business together?
I don't know whether that is the definition, and that definition is correct, but I can just say, I think my leadership style is, yes, my leadership style is hopefully getting people involved, giving enough responsibility to them, and believing in people, young people, giving them opportunities, allowing them to make mistakes, because I know I have made many mistakes and I continue to make them. And I think to that extent that is, and trust people unless something, which is really wrong after a long time. So if that is a style, maybe that's how it is.
And Nandini?
So I tend to be very structured. I like lots of data, and I like to understand and build a framework in my mind. But I think it's also about collaboration and trusting people who are experts in their area, because as the businesses become more complex, there's no way a generalist can really understand and get into the nitty-gritties of manufacturing, and that's the manufacturing head's job. So I think trusting the people, giving them freedom, I think that's in a way we're quite similar, but also encouraging collaboration.
Right. And I'm sure it's very challenging also, because when Mr. Piramal built businesses, for him, he was the first-gen entrepreneur. When you are inheriting those and trying to build on it, the challenges are different. How do you ensure that the legacy stays, and how do you really build upon them?
So I think this is one of the things. I think values create value, and I think that's the culture, and that's what makes it real. So I'll give you an example. I think we had a team member of my dad's who would come and talk to a lot of our pharma people. And he's like, yeah, this seems pretty much like the old days. The kind of the values and the culture that you have is not any different to what we had even when he was more involved in the pharma business.
But is that a baggage? Do you perceive it as?
I think I actually agree with him. I think they're constant, and I think they'll always be your North Star, and you have to continue to live by them.
Right. Mr. Piramal, how do you see? Do you see it as more challenging for them to build on what you've already, what is your take on it?
I think everybody has to go through their own challenges. There are opportunities and there are challenges. When I began my business career, we had a textile business, and I was thrust into really leadership at a very young age because of certain family, let's say, tragedies. If I can say, my father passed away when I was very young, and so did my eldest brother, who was the chairman of the group, and textile was going through a difficult time. But that was a different time, and one could go from one business. I went into pharma and so on. But each one has their own challenges, so it's not that what is more difficult, what is not. I think this is part of life.
Are you passing on the risk-taking ability to the next generation?
It is for people, each one is also made differently. So whether I'm not deliberately passing on anything, it's for both. My kids are now running their businesses independently. It's for them to see if they like something, they will do it. Otherwise,
you've just had 30 years of conversations at the dinner table, which still continue.
Right. And how did you arrive at, who inherits what? How did you know that, this piece of business should be run by, say, Nandini, and the other piece by...
So it's actually just the way the interest of each one of them was, that I know that Nandini was always interested in the pharma business right from the beginning, and therefore her deep understanding of that business. She, after, she's studied at Oxford and then went to Stanford to do her business school, and then joined McKinsey. So she had a wide experience of this. And fortunately, her husband is also somebody who she met at Stanford, who also worked in McKinsey in pharma. So he also had a particular knowledge of pharma and an inclination for pharma, so it just worked out like that. On the other hand, Anand was, whilst he was studying at Harvard, he wanted to do real estate. He started with real estate, and then real estate, financial services to some extent are very closely related, so that's how he's got interest in that.
Right. And how do you handle conflict, situations? Because, when there are, there isn't meeting of mind, say a decision needs to be taken about a certain business strategy, and if Nandini has a differing view and you have a differing view, how do you really tackle that within the family?
So my view, it depends at what stage you are. I think now both Nandini and Anand have got enough experience that my view is that I may differ with something, which is not very often, but if I do, I just express my opinion. I may say it once, twice, but ultimately the decision is theirs. I don't want to take responsibility now for the actions after that. That's how I've been brought up. I was given responsibility very early in life. I made the decisions, right or wrong. I got either the credit or I, made mistakes. So I believe that's the best way to do it.
Right. A lot of legacy businesses have suffered because of stagnation in their core business. You have constantly innovated and, gotten into newer lines of businesses. Do we see, more such businesses that you are excited about? What are the two themes, say, of future, say 10 years down the line, the sunrise sectors that you are excited about?
So fortunately for us, the sectors we are in are actually both in some ways sunrise. Or they are mature in some ways. If you look at it, both pharma and financial services are very mature businesses. But actually the nature of the business is changing every day. So whether it is is it sunrise? I think yes, there are so many new activities happening in pharma. You see the amount of change, the amount of innovation that takes place in pharma is probably more than anywhere else. And we read so many new technologies coming in the pharma space, and the ultimate purpose of pharma is the same, which is how do you alleviate human suffering. But the methodology changes. So in that sense, they are always new and it is always a sunrise. Similarly, financial services, the amount of change that is taking place on a daily basis is significant. So in that sense, I would say that these are really businesses where you have to always remain on the top to understand what the changes are or what are likely to be the changes, and you come and adapt yourself to that.
Right. A lot of founders suffer from, lack of succession planning, where, we have seen a lot of businesses, and we keep writing on those, on a daily basis, are either getting sold to strategics or private equity investors because there's, the next gen is not interested in running those businesses. So what would be your one advice to founders on succession planning, because you've successfully done that yourself. So what is that one advice that you would want to give?
My only advice is that you have to give the choice to your children. And ultimately, I believe that each one must do what their own internal passion is, or what we call swadharma. If you have to do what is really you're passionate about. If you're passionate about running your business, you should do that. But you don't have to force the person, the next gen, that you have to do my business. If they're passionate about music, they should do music. So, I believe in that, because that is the only way you can be successful. And at the end of the day, what is the most important thing in a human being's life is to be happy. And you can only be happy if you're internally happy. You cannot get happy by outside this thing. It's internal. And that happiness comes only if you pursue your swadharma, or your real passion. So that's my belief. So some people's kids, like in my case, both my children wanted to do business, and therefore they are in business. But if somebody wanted to be an artist, so be it.
Right. It's interesting that you spoke about Swadharma. A lot of your, life is driven by this entire influence of Vedanta and Bhagavad Gita. If you can talk about say 2 lessons from Bhagavad Gita that have been your driving force in running businesses, and then we can maybe Nandini, you can also talk about it. It would be great.
So if you look at it, all our values, all our purpose is really nothing new. It's all based on what has been said thousands of years ago. I think we need to appreciate that the Gita was taught to a young person who was the most successful archer at the prime of his, let's say, skill when he was in his 20s. And Arjuna, who it was taught to, was in the midst of a battlefield. So therefore, those lessons are not told to somebody who's sitting in the Himalayas or in the mountains in isolation. It is for everyday life. So that's what, so when I said about purpose, this is from the Gita. What is it? That you have to also make a difference to the world around us. We are actually privileged to be born as a human being. And we owe it to society, we owe it to nature to give back and make the world a better place. That is what the Gita says. The Gita also talks about, let's say, about doing, the Gita also talks about focusing on action, not worrying about the result. Because what is result? It is only the fruit of the action. Only when you lay a seed into the ground will you get the fruit. And when you lay the seed, you water the plant, that's how the fruit comes. I can't think I'm getting a fruit and just chase it without laying the seed. So that's it. The courage to take on things which are different is again in the Gita. So I can go on. There's everything that at least I know in life is I have learned from there.
Right. Nandini, Anand spoke about, the previous session, the, need for spirituality, in equal amount. What is your take on spirituality and how important it is for an entrepreneur?
So I'll actually say I'm not very spiritual, but I am someone who believes in the necessity of purpose and the necessity of living your life according to your own personal values. So I think those two are how I would live my life.
What are the 2 values that are driving you as an entrepreneur?
I think I would agree with sort of integrity and trusteeship amongst the 2 that I think make a big difference.
Right. Mr. Piramal, how do you, balance the need for professionalization and merit-based leadership with the importance of family legacies and values and, succession?
Sorry, say it again.
Yeah. How do you balance the need for professionalization and merit-based leadership, with the importance of family legacy, on one hand you have to pass on the family legacy, and on the other hand you have to also ensure professionalization and, merit-based leadership.
I think there is no conflict between the 2. First of all, I think if I look at my own kids, as I said, both of them have been well qualified. Okay, just because you've been to a Harvard or a Stanford doesn't make you a good, successful person, but they've also got the right experience. And ultimately, this is what I don't understand. When you talk of professionalism, on one hand, you say that we should have employee stock option. That ties them. Who has the biggest stock option in a company is the family. And if you're a smart family owner, you will realize that it is in your own vested interest to see that you have the best talent. Because who gets the most benefit? The family gets it, because you have the largest shareholding. So I don't find there is any conflict between professional and family. That just because you're a professional, does it mean that you will do better? No, it's not true. And honestly, sometimes in the most difficult times, the family will stick it out. Very often I've seen, it's not always, but I've seen professionals leave because they have options to go elsewhere. The family has no other option. So I think it is a mix. It's a smart family person who is smart would see that the best people work for her or him and continue to prosper.
Right. So skin in the game is very important, like Mr. Piramal said. So Nandini, building on that, when you confront difficult situations, like he said that, often a professional manager versus, say, a family, how have you tackled those? If you can, help us with some example or an anecdote, that would be great.
I mean, I think it's important to have not just, you may call it a board of advisors, but it's people that you trust, that you can be vulnerable with, and actually then have those discussions. Because, it may not be your public company board, because they also have other responsibilities, but you have to have mentors, friends, and family that you can be completely honest with, and that can therefore give you good advice. And they have to know you, they have to understand your business, and they have to then also be, sometimes also say, like, look, this is what you kind of have to suck up and do, and you just put your head to the ground and you do it.
Right. And Mr. Piramal, at what point does one need to plan for succession? What is that inflection point when you really have to start thinking about succession and ensure that you are building a roadmap for the next generation to step in?
I don't know if there is a specific time or age. I think it's just that when you find that if you are having a succession with your family, that they are ready to take up the responsibility. And I find that over time, we started both, as I said, with both Nandini and Anand. They were getting more and more responsibility, and they were taking it on. And therefore, at some time, actually, it's more important for people who have been used to running the business like I have been, to actually just step away. That is more important, I find. And very often people think that, oh, I know all of everything and my next generation will make mistakes. So what? Even if they do make mistakes, it's fine. We all have made them in our life. So it's better to, I think it's more important yourself to know that you have to step aside and actually do it.
Right. That's really interesting, to know when to step aside. I think on that note, we would end this session. Thank you so much, Mr. Piramal, and thank you, Nandini. It was a really enriching chat. Guys, please let's have a huge, huge round of applause for them. Thank you so much for taking time out.
Thank you so much, Sneha, for engaging us in this conversation, and I'm going to request you to kindly present a token of our gratitude to Mr. Ajay Piramal and Ms. Nandini Piramal. My dear friends, a huge round of applause is due for this moment and for this conversation. All right, so even though we're slowly inching towards the grand finale, in fact, simply because of that, and then we've reserved the rest of the evening for networking, I want to once again introduce all of you to the networking system that we've put in place. So whenever you registered today, you would have received a QR code on a WhatsApp message from Mint India Investment Summit. Right under that QR code, you have the opportunity to click Join Now. And as soon as you click Join Now, you have various subcategories that allow you to network with like-minded people right here at the Mint India Investment Summit. Along with that, I'm actually going to invite you to please take a look at your networking zone, because there are very high chances that you've already received a couple of networking requests, but of course, because the on-stage agenda is so cool, you're so tuned in and you probably haven't had the time to look at it so far. So please make sure that you Stay tuned onto that networking platform, which is driven by AI. Continue to find like-minded people. Also assess the requests that you've received so far so that you can make the most of the networking evening that we have very, very shortly. I must also thank all of you for sharing your thoughts, your insights onto social media platforms. And while you continue to do that, please don't forget to use hashtag MintIIS2025. Well, ladies and gentlemen, we're now going to pause the headline optimism and put on our microeconomic goggles, because beneath the headlines of fastest growing economy, there are some tricky questions. And to decode that, to tell us what the charts aren't showing, we've got one of India's sharpest economic minds, someone who does not just analyze data, but interprets it with nuance, with context, and the precision of a surgeon. Currently, he's the chief economist at Axis Bank, a key member of multiple advisory councils to the government of India. Please join me in welcoming on stage Mr. Neelkant Mishra, who will be in conversation with Ravi Krishnan, editor-in-chief, Mint. Let's welcome them with a thunderous round of applause, everyone.
So, Mr. Mishra needs no introduction. He wears multiple hats these days. Apart from being chief economist, he was an equity strategist earlier, so he's conversant with both the equity markets as well as the economy. He advises the Prime Minister. He is chairman of the Unique Identification Authority of India. Thanks for taking out time, Mr. Mishra. So, let me start by asking you, you would have already guessed where I'm heading with this. This is about the chaos which has been unleashed by the new US president. Of course, it's very hard to predict which way things are going to go. But how does one deal with this level of chaos and uncertainty, when you are analyzing things?
Yeah, so yeah. So, see, underneath this chaos now, I think we've seen the chaos long enough for us to start to look at patterns. So, as I see it, there are three major objectives. Now, how these objectives manifest themselves over what period of time will tell. But you can see that the Trump administration is trying to solve for one, we don't want to sacrifice any of American interests for multilateral issues. So now you must have seen, so they stepped out of WHO on day one, but now they've stepped out of funding the WTO. The US is no longer interested in giving defense for free. So I'm sure there'll be some hard asks from Korea, from Japan, like Germany, Saudi Arabia. So all of them, I think there will be bilateral discussions. So they do not, and similarly, on the trade side, they don't want to have, take the market leadership in saying 0% duties for me, and you open up as much as you would like. So this is clearly an objective that we do, and that is why we should get used to more bilateral deals, not just with the US, but across the world, because multilateralism that we've all been used to is getting over. So if things have been chaotic, just wait and see. I think they will get a lot more chaotic before they start to settle down. The second objective is what we could read in Stephen Miran's November 24 paper, where he talks about the costs of being the global reserve currency, that our currency is persistently overvalued. And frankly, just like, the Triffin dilemma that led to Nixon breaking the gold standard in the early 70s, now we have reached a stage where if you want to be the global reserve currency, you need to keep having a current account deficit, which means that your net international liabilities continue to rise faster than your international assets. As of now, the US is a net debtor of $18 trillion, 60% of GDP. Now, this is not sustainable. At some point, it had to break. And now what they're saying is that, look, guys, we want a weaker dollar.
I don't think they are saying that we don't want to be the reserve currency of the world, but that's inevitable, and that's going to change as well. The third thing that they want to do, and this sounds illogical to everyone because we are so used to having income tax as the primary source of tax revenues, is that they want to generate revenues out of tariffs. So they are saying that between 1866 and 1913, 50% of US federal revenues came from import tariffs. And they're saying that, look, we got only $80 billion last year. Remember, the federal revenues are about $5 trillion. We got only about $80 billion last year. We can generate $300 billion extra, and we can give $400 billion of tax cuts. So the US consumer is such a powerful pool that we can generate, because everyone who wants to tap into it, pay a hafta and sort of, it's an import tariff. So these are the three major objectives. And I think all of them and you can understand why his team believes in them. And they're going to act on it. And I don't think 2nd of April, which most people in the market seem to think is like an end date, as if, there is a certain tariff rate that you adjust to and say, move on, life goes on. It's the start date. Because the moment multilateralism ends, everything else starts. Because look at export subsidies. The World Trade Organization, the fear of the World Trade Organization was why people didn't have export subsidies. Now, everyone will have export subsidies. If China, for example, if already at 20% import duties, if the Venezuela tax starts to get added, 45% import duties, what do you think happens in China? They start dumping into Indonesia, Malaysia, India. We start raising tariff barriers. They start devaluing their currency. Look at what happened from 1930 to 1936, and you will see a pattern of what can happen. So I think this is the start of a prolonged period of uncertainty, but the broad direction of travel is based on these three parameters.
So what do you think is going to happen to trade? I mean, we'll see more bilateral treaties. India, for example, is negotiating with the US. There is a UK FTA in the works. There is a EU FTA in the works. But what patterns in trade do you see emerging?
See, the first thing is that when you have bilateral agreements, that's a suboptimal solution because you're trying to maximize through a lot of local optima, whereas a global optima is definitely superior. When you see the parameters of the India-US trade agreement, it's clearly that India would like to see better access to the US apparel markets because one of the biggest disadvantages India has had versus a Bangladesh and a Vietnam is that we didn't have an FTA with Europe, UK, or the US. And the fact that the US is kind of cracking the whip and forcing us to cut duties means that a lot of the Indian lobby groups which were preventing the FTA from getting signed earlier now have to stand by the wayside. So indirectly, it actually may be even better for us because, and this is again something that I'm surprised more people don't talk about. See, trade works through, the impact of trade on growth is through the channel of productivity, not end demand. Today we are give or take a $4 trillion economy. At some point, if you're bullish, 15 years, bearish, 30 years, we will be a $20 trillion economy. So we are going to add about $16 trillion of GDP. I think it is very reasonable to expect that not more than 1 trillion of that 16 trillion will come from net exports, change in net exports. Even today, China, which is the biggest and the most distortionist manufacturer the world has ever seen, their goods trade surplus is $1 trillion. So as we think about the world and as we think about trade openness, we have to realize that if you have an open trade and lower duties, your manufacturers are forced to become a lot more productive and efficient. And so to tap into export markets and to resist competition from abroad. So there are areas where we need strategic competitiveness, but there are many sectors where our manufacturers have had a sufficient level of protection for a long enough time that if they were exposed to competition from abroad, some of them should be able to thrive and improve themselves. So all in all, I expect that better access to the apparel, footwear markets of the US, and there is not too much of a threat of US imports coming in except for maybe some agri-commodities and a few others. So therefore, net-net, we may not be that badly off.
Right. But exports as an engine of growth is something you're not a big believer in.
That's something that I think is very misleading. See, if you are a Thailand or a Malaysia or a Taiwan or even a Korea is slightly bigger, you can rely on exports as an engine for growth because that's where you rely on end demand abroad. When you are an economy the size of China or India, net exports, maybe for a temporary period, this is what happened to China between, say, 2000 and 2008, can be a driver of growth and initial spurt in income which drives consumption, etc. But on a sustainable level, we have to tap into our domestic demand. So as I said, trade openness works only through the productivity channel. So the more we open, the more productive it becomes. So TFP, total factor productivity, goes up. When we are thinking of end demand, we have to rely on internal demand. Even today, China, 19 trillion out of 20 trillion is domestic demand.
Speaking of growth, GDP has slowed in the last 6-7 quarters from nearly 9% to around 6.5%. Now this slowdown happened even before. Okay, anyway, we are discounting exports. But where do you see the economy headed? Do you think we need a rate cut, for example, to reverse this slowdown?
So there were, one, I believe that this is a cyclical slowdown, not a structural one. So there are people who were earlier gung-ho about 7.5%, 8% growth and now saying, oh no, 6% is a structural growth. I disagree. I was at, even when very senior people were talking about 8% growth, I was saying, no, 7 se zyada, it's very hard to do more than 7. And even today, I think that 7 is our structural growth, and this is a cyclical growth slowdown. There were 3 cyclical factors that went against us in the last year. The first was fiscal. And on fiscal, my interpretation is actually very different from what I hear in the press and from some other economists. That the government was supporting growth so far and it's no longer in a position to support growth. Facts are exactly the opposite. So what economic theory says, and that's actually quite true, is that if your fiscal deficit shrinks, it is a drag on growth. If your fiscal deficit expands, it is a boost to growth. So there are 2 parts to the fiscal story. The first is that the government has gone from 6.9 to 6.4 in FY23 to 5.6 in FY24 to 4.8 in FY25. 50 basis points, 80 basis points, 80 basis points. It seeks to do only 40 basis points in the next year. So the headwind to growth from the planned fiscal consolidation of the central government are actually receding. So it is supportive of growth, right? It's a negative of negative. The second aspect of fiscal was that spending in FY24 was front-loaded. Spending in FY25 is back-loaded. So there was an 8-10 month period for various reasons that government spending was no longer supportive of growth. And that phase is also over. So basically we are seeing very rapid spending growth in the last 3 months of the year. So it is now reasonably clear to me that fiscal was a big drag. It is going to be less of a drag going forward. The second was regulatory. So I think for a variety of reasons, all regulators, financial regulators, even the government folks, they started to, I think, 1, take growth for granted. 2, perhaps became very worried that bubbles will form and it will create a lot of problems. And when growth is very rapid, things change and people are uncomfortable with change. And therefore, they started slowing down the process. So more and more circulars issued, more decisions taken which need a lot of interpretation, more warnings issued, and so on and so forth. But as we are seeing with a new set of regulators in place and sufficient amount of concern that growth is slowing down, we are saying that the regulators themselves are saying, you know what, we need to balance safety and efficiency. And therefore, because safety comes at a cost. And so we need to look at the cost that is coming to that growth. And so regulatory headwinds are easing. Coming to the monetary side. I don't think rate cuts are going to be very effective right now. So,
Liquidity being very
yes. So, India currently, and I think this is because the RBI kept liquidity too tight for too long, and I don't know if they were deliberate about it or they just thought that it was not their problem. The gap between the actual cost of funding and the theoretical cost of funding, if you remember the 2008-9 crisis, there used to be this FRA-OIS spread. It's the forward rates agreement, basically the funded rate, and the OIS is the actual theoretical rate. We used to track the spread to understand what was the stress in the financial system. Because if banks and financial firms are exchanging funds at a very high spread, which means that they don't trust each other. Today in India, the FRA-OIS spread for the 12-month period is like 150 basis points. Now, it is starting to fall with the seasonality, but it is a ridiculously tight situation. So the 3-month CD rate from February to middle of March actually went up despite the rate cut. So for the economy to be supported by higher credit growth, you need to first bring down this spread. So you need to ease liquidity. And not just ease liquidity, but give comfort to the financial system that you mean it this time. And I think a lot has been done, and the governor has actually taken a lot of steps to OMOs, buy-sell swaps, whatever. Durable liquidity, which used to be 2% in September, had dipped to 0, actually negative for a while, because of the currency interventions. But now they're up to about 1% of deposits. I think they need to take it to 2%. That's my view. It could be wrong. They need to take it to 2% of deposits again. And then I think with a lag of 3 to 6 months, you can see banks becoming comfortable growing their loan book. And once that happens, the only conditionality is now how bad the global situation is, because the global situation will get much worse. But for domestic reasons, I think growth should get back to the 6.5–7% range.
Fair enough. So you were talking about regulators, passing a lot of orders. Recently, I read you saying that India should also have a Department of Government Efficiency. Okay, maybe not without a Musk-like person heading it, but even the economic survey and the budget were talking about deregulation. How big can it be as a driver of growth?
No, it can be a very significant driver of growth. So deregulation in general, and in fact the government is working on it. So they're going to set up a committee which will look at all the unnecessary rules and regulations. See, we are actually, the fact that the government moves much slower than what you and I would expect and would desire is the reason we grow at 7 and not 10%, right? But there has been action. There has been a significant easing of regulation. If you look back what the things that used to happen 10 years back and the things that happen today, the pace at which government decision-making happens, I think there has been a significant improvement. There is a long, long way to go in terms of the administration of direct taxes, the administration of indirect taxes. Someone was tweeting about how the Department of Metrology, something which is absolutely ridiculous, but they will come and, harass. Now, these are things that distract entrepreneurs, small business. And as Anant very rightly writes in the economic survey, it hurts the medium, the MSMEs much more than the larger firms. And therefore, I think that deregulation is important. But when I talk about government efficiency, I'm not talking about a department of government efficiency. Frankly, our state is too small to be whittled down like that. In fact, I would think that the government should be bigger in the right places. It is, I think, right now big in the wrong places. But what I do think is that we have too many departments. Like, why do you need a ministry of coal, a ministry of oil and gas, a ministry of power, a ministry of new and renewable energy, and the batteries are done by the Ministry of Chemicals and Fertilizers? If the US, which is 7 times our size in terms of economy, has 16 departments, the central government, why do we need 85 departments, 53 ministries? If you see how, say, electric vehicles, Ministry of Heavy Industries does the cars, Ministry of Electronics does something on the electric vehicles are electronics in a car, right? And then batteries are chemicals and fertilizers. Now we are already, I think, at least 10, 15 years behind the Chinese. We have a much lower capability of giving fiscal support. And here, the decision making is spread across 3 ministries and therefore not very efficient. So as we get into an era of industrial policy competition, so remember that the end of multilateralism means that every single tool of industrial policy is going to be deployed by the world. So everything from weak currencies to labor subsidies to capital subsidies to directed credit, all kinds of tools will be used. The government then needs to be much leaner and much more focused on the areas, the problem areas. So when I talked about efficiency, I meant that government organization itself needs to be much more focused. Currently, it's too distributed.
Industrial policy competition. So PLI scheme is also an example of that. And now there are murmurs that, you know, the government might not extend the scheme because in certain areas, like electric vehicles, for example, it has not seen much of a success, frankly. I mean, what do you think? Should the government actually extend the scheme? Should they tweak it because of this changing scenario where you're saying we need to use all these tools?
You must have seen that the PLI scheme on electronic components was announced today. So it is not that the government is stepping away from intervention. As I see it, many of these PLI schemes, the way I see PLI schemes, the intent was to create large manufacturers from India. And to the extent possible, attract foreign manufacturing to India, because then expertise, machinery, value chain linkages all get formed. And this is exactly where China was. And I'd like to repeat this, that in 2004, nearly 60% of Chinese goods exports came from foreign firms manufacturing in China. You must have seen about that story of the tunnel boring machines, which the Chinese are stopping at the ports. And it's been by the German companies in China, right? So even today, 1/3 of Chinese goods exports are, so $1 trillion of goods exports from China are foreign firms manufacturing in China. So those were the objectives of the PLI scheme. What ended up happening, because while that was the intent from the top, as it went to the line ministries, it very quickly descended into, oh, you know what, we shouldn't be too selective. You know what, let's give it to 50 firms. Now, the moment you give incentives to 50 firms, it becomes too small to make them competitive in a global market. So, for example, you know, the reason that the 2,000 crore footwear scheme hasn't taken off is that the industry wanted that, you know, there should be 20 crores given to 100 firms. That's not going to work. Because today, you know, the Indian firms add 10 lines, 20 lines. The Chinese and the Taiwanese don't see below 200 lines, when the assembly lines, that is. And so unless you give 200, 250 crores to 8 or 10 companies, it is not going to be effective in attracting global demand or making Indian firms efficient. So I think there are lessons to be learned. I think the decision not to renew is the right one in most cases, because the schemes themselves were not aligning to the objectives that, I think some of them were unstated objectives. Perhaps that is why there was a bit of slippage. But remember that this is, and it is also the right message that unlike some of the earlier incentives which lasted in perpetuity, that you start with an end date but you don't stop it, that makes the industry lazy. I think it's important to say that, okay, it's not working, we're going to cut it. But as the launch of the PLI for electronic components today says, that in principle, the government is still focused on it. I think the government may tweak it, take lessons from it, refine it, and then launch it again. Because you will need, I think, a lot of industrial policy action going forward.
Okay. Let's take a couple of audience questions now.
Mm-hmm.
Before. Yes, please.
Yeah, so it was a very insightful discussion, and you mentioned various things about the dollar. So particularly about the dollar as a reserve currency, do we actually need the dollar as a reserve currency? Because I've been given to understand that around 60% of the trade happens in Asia, within Asia itself, like China exporting to some other countries within Asia, Vietnam exporting within Asia, and due to the Trump tariffs and things like that, this trade, intra-Asia trade, is just bound to grow. So when we are trading right within Asia, why would we need the dollar?
This transition is not going to be easy or a very short one. So you're absolutely right that the center of gravity, see, the time at which the dollar became the reserve currency of the world, say starting the mid-1930s, and then got cemented with the Bretton Woods system. And if you read the history of what really happened at Bretton Woods, you will see how contested it was. That Keynes said that, look, this is, the Americans are becoming too dominant, that everything is being linked to the dollar. And then you see how the euro-dollar market in the 1950s and 60s emerged. It is actually quite fascinating that because there were so many dollars that the Americans had parked outside, they had to find out mechanisms so that those dollars didn't come back, because otherwise they would have had to pay in gold. And that led to the Fed easing regulations, allowing dollar to be held by European banks. So this transition was a very well managed one. If you see Barry Eichengreen's paper on, or the book on the US dollar as a reserve currency, you will see that the transition from the sterling to the dollar was not an automatic one. Starting with its formation in about 1913-14, the Fed passed many regulations which allowed the dollar to be a lot more freely traded. People became comfortable holding the dollar, and that's when it became a reserve currency. The whole point is that you need one currency which everyone is comfortable with. Because if you think about exchange rates, because we all understand buy-sell, the spreads, so the point is maintaining, suppose there are 30 currencies in the world, maintaining liquid exchange rates for all those 30, it's NC2 problem, right? It's 29C2, 30C2. You need to maintain a very large number of liquid exchange rates. The moment you have one currency in the middle, you just have to maintain 29 liquid exchange rates, which is why economically it is very efficient to have one currency which everyone is trading against. Unless you find another alternative, it is going to be very hard to displace the dollar. So I think the process has started. It would be unwise for us to expect that the dollar will not remain a reserve currency even 5 years later. If you were asking me what would happen 15, 20 years later, I think the likelihood of reserves for many countries being in non-dollar assets or a large part of invoicing globally happening in non-dollar currencies, those probabilities will be much higher. But I think it would be unwise to expect that the dollar will be replaced as a reserve currency anytime in the next 3 to 5 years.
One final question. Yes. Yeah, absolutely delighted to hear you, Mr. Mishra. So my question is, world's one of the biggest hedge fund manager, Mr. Ray Dalio, in its last book, The Changing World Order, he talked about the stage 1, 2, 3, 4, 5, 6. So 5 is more about decline and 6 is collapse. So he had made a comment regards US is in stage 5 where rising powers, and stage 6 is about flight of currency and devaluation. So if it materializes, so definitely the time span is 15, 20 years, but how it going to change, and what could be the tectonic shift? Because it comes with by a guy like Ray Dalio.
See, Ray has his own worldview, but I think it's a very important question. You go back to, I briefly mentioned the 1930s, when the Smoot-Hawley tariffs were imposed in 1930. In 1931, Japan broke the gold standard. 1932, I think sterling broke the gold, the UK broke the gold standard. Then 2 years later, the US broke the gold standard. And you plot the industrial production from these economies, you will see that France, which broke the gold standard the last, which is 1936-37, its output kept falling throughout the year, throughout the decade. Japan was the best because it broke the gold, so it devalued its currency. And remember that the currency movements against the dollar in that decade were 50 to 250%. So that axis itself is quite scary. So I'm apprehensive, though I'm hoping that it doesn't go down that path, I'm apprehensive that we will see similar currency devaluations, not of that magnitude, but attempts to devalue the currency in order to stay competitive, and that can create a next level of chaos. Till the time that, again, some global entity, it could be G20, it could be the post-Trump presidency, which then gets everyone together and says, you know what, guys, let's have this new world order and let's settle it. So this change is overdue. If you look back, starting with the mid-16th century, every 80 to 100 years, the world order changes because new powers emerge. They have to be given space. The existing powers don't want to do that. Some kind of tussle happens, and then a new world order. There's a big treaty, like there was the Treaty of Vienna. You must have heard about it. So all of those things lead to a reset, and that reset could be several years away. And so all I can say is that I think the period from now to then could be quite turbulent when it comes to global economics.
That's all we have time for, unfortunately. Thank you very much, Mr. Mishra.
Thank you, Ravi. Thank you, Ravi.
Ladies and gentlemen, Mr. Neelkan Mishra.
Thank you so much, Mr. Mishra. Ravi, kindly present a token of our gratitude to Mr. Neelkan Mishra. Ladies and gentlemen, another thunderous round of applause. All right, so you've seen him on screen, you've seen him on court, owning a kabaddi team and a football franchisee. But he's also someone who knows how to play the long game, both in cinema and in investing. His investment picks, I'd call them as layered as his roles, thoughtful, risk-aware, and deeply passionate. When a film star steps into the world of investing, what does he really bring to the table? Is it instinct, intuition, or plain insight? Let's find out how this leading man reads a pitch deck and how he looks at the intersection of creativity and capital. Please join me in welcoming on stage with a thunderous round of applause, actor and investor, Mr. Abhishek Bachchan, who is in conversation with Gaurav Lagadhe, Senior Editor, Mint.
Thank you. Hello, everyone. And while I have a man here who doesn't need any introduction, but still I would try to say few words. Like, he has been a cool con man of one of my favorite movie, Bunty and Bubbly, a gritty gangster in Yuva, and no-nonsense cop in Dhoom. But off-screen, a pretty intense kabaddi team owner, right? So, and everything, basically, whatever he has done with style, with humor, and with a whole lot of swag. So, please welcome me in joining Mr. Abhishek Bachchan for this fireside chat. Thank you. So let's start with kabaddi, right? 2014, when kabaddi was not exactly a sexy game, right? Cricket IPL was had become #1, and IPL had so many followers and all. What made you invest in kabaddi? What was the idea behind it, behind the team owning?
Firstly, good evening, everyone, and thank you for having me. Kabaddi was something that literally came out of the blue. It was a chance meeting with Mr. Mahindra and Charu Sharma, and we have a common love for sport, and they knew I was a big lover of all sports. And Mr. Mahindra just by chance asked me, said, I know, I like basketball very much. So he said, and we always discuss basketball. So he said, I know you like your basketball. Have you ever thought about kabaddi? So I said, I played it as a kid, but no, why? What are you thinking? And he said that they were planning on putting a professional kabaddi league together. And it just sounded like a good idea. And I think that's a good starting point for anything. It should appeal to you. So me and my team went about doing some research on, kabaddi, because having played it as a child, you still think of it as that very rural sport played in mud. But if you see modern day kabaddi, it's very modern, it's very fast-paced, it's dynamic, colorful, and terribly exciting. And I remember we found out that there was a local tournament going on about 15, 20 minutes from my house in Juhu. It was being played in a chawl. And I went there in as incognito as I could. And there were about 10,000 people cheering and watching and going crazy. And the energy was insane. And I turned to my team and I said, we have to be a part of this. This sport is very exciting. And that's where it started from. It just started on a hunch. It started as most things that I do out of just a love of doing what I want to do. And there has to be a personal connect. I like the idea that Kabaddi is India's indigenous sport. It's over 3,000 to 4,000 years old. It has its origins in, Hindu mythology with Abhimanyu and the Chakravyuh. That's actually how Kabaddi came about. That's why you have 1 versus 7. Chakravyuh was 7, circular motions. And I just like the idea that we could put a professional league together for India's own sport. Cricket, football, we love them all, but they're all inherited from, the West. So that's how it started. And thankfully, it went on and has become very successful, so no complaints.
I mean, I've seen you at the final of, I think, last year when you reached. You were there fully supporting your team, right? And it was very, very interesting to see full passion. You were there, you were out in the mud. But that's one Kabaddi. What are your learnings from owning a team like Jaipur Pink Panthers?
Get a regular ECG done, I think, is the biggest learning. It's very stressful. But I think my greatest learning after season 1 of Kabaddi was that where there's a will, there's a way. I didn't come from a background or was trained or equipped to run a professional Kabaddi team. I'm a film actor by profession, and that's where my training lies. But this is something I really wanted to do. Sports and ownership and management is something that I've always wanted to be a part of. And I think the greatest learning, apart from several other smaller ones, but the big learning was that if you really put your mind to it and you want to make it work, and you work really hard, it can happen.
So from Kabaddi to football, 2 very different games, very different origins. Why football then?
I'm a big football fan, and I went to a British boarding school. Football was part of your life growing up. I was a huge football fan of the English Premier League. I had, as a child, spent a lot of time in Chelsea in London, so I was a Chelsea fan. And I remember many years ago at one of the World Cups, I think it was Rio, if I'm not mistaken, I had a chance meeting with Mr. Sepp Blatter, who was the then, the head of FIFA. And he, in a very joking manner, said, 1.2 billion people, you can't put 11 guys on a pitch. And he laughed. I got offended. I was like, but he's right. With the kind of talent pool that we have, why aren't we competing in the FIFA World Cup? And that's where I decided that I have to do something with football. And coincidentally, around that time is when the ISL was being put together. And me and my partner, Vita Dani, we won the bid for the Chennai team. And that's where it started. So it started from wanting to make a difference, believing that we could hopefully help the ecosystem. And, it's a matter of pride that since the ISL started, our national rankings have grown. So you can see that there is some payoff over there. So football is because, I was a big fan of football.
But Chennai FC, in a way, had its highs and lows. So, how do you approach leadership when the scorecard is not in your favor?
It's very difficult because for me, with pretty much all that I do, be it a film or be it even in sports or anything, I've always said, apart from just being one of the owners or owner of a team, I'm also the first fan. So I take it very personally. I don't like losing. But the one thing sports teaches you is how to deal with the loss. What's the important thing to learn is how can you trim your sails and carry on? How do you adapt? How do you learn from your mistakes and pick up and go? But, 10 seasons, Chennai's been champion twice. I think that's a pretty fair and healthy success rate. But yes, it's a sport. Somebody's going to win, somebody's going to lose. You just have to learn to keep trying to be as consistent as possible. So it's very difficult. Like I said, it's not for the faint-hearted. We were discussing this backstage. But I think one of the learnings is you can't, in sports especially, you can't really rest on your laurels. Even if you're the champion, I think you have to work twice as harder the next season to maintain it. So it's not like, don't fix something that's not broken. It's not about something that's breaking, but your players are there. They're going to get older. They'll get slower. They're going to be different formations. There's so many moving parts that it's a constant process of evolving and adapting and learning.
I love to say that about our job also. We journalists are as good as our last byline.
Yeah, well, I guess everybody in this room is as good as their last release or product, I guess. Yeah.
You opened the gates for this documentary, Sons of Soil, right? For Jaipur Pink Panthers. Was that the actor inside you, producer inside you, or that was always the plan to open it?
No, that was always the plan. That was one of the things I love doing. I love watching sport documentaries. They're very inspirational. It's nice to see what goes on behind the curtains, in the wings of the sport. It's something that I've always been very, very affected by, and I was very keen to do that with especially Kabaddi, because I feel there's a huge story to be told in Kabaddi. And so I was very, very happy that the BBC and Amazon Prime decided to come on board and make Sons of the Soil. It's the first ever sports documentary on a Kabaddi team, and thankfully drew a lot of interest. So it wasn't the actor in me. I mean, I wanted to take a back seat, but make it about the players, which predominantly it was, but obviously being the owner of the team, they interviewed me a lot.
No, but does it help to be, when it's a celebrity, when it's an actor, and a storyteller in a way? Does it help the team also in that brand rub-off effect in a way?
Interesting. In terms of ownership, I don't think so. I think with maybe sponsors, slightly, because you can leverage your celebrityhood or whatever little celebrityhood you have to get that initially. But at the end of the day, I think people, after a period of time, the sheen wears off, and it's more about how's the team performing, what is the demographic that it's appealing to, can I advertise over here, other people. For example, football and Kabaddi are two very different sports compared to cricket. Cricket is a very advertising-friendly sport. After every 5 minutes, you can break to commercial. It's a slower sport, so there's a lot more visibility for sponsors. Kabaddi's high octane, full contact, very fast. And there's no changeovers, nothing. It's a 20-minute half that is relentless. So there's lesser visibility. There's lesser time to give, advertising. Plus, the demographic that would possibly see Kabaddi is very different to that would see football. Football currently is a very urban-centric sport. Kabaddi is pan-India. Thankfully, it's broken into metro cities as well. So, you have different kind of advertisers that will want to advertise. And, so as a celebrity, you can draw a bit of attention to that and say, okay, I'll leverage myself. But after a while, they're like, okay, is this really helping our brand grow? Are we getting the kind of exposure that we want? Do we get the bang of the buck that we need? So I think initially it does help, but only in the sponsorship. As in ownership, no, not at all. It's actually detrimental because actors, I think, have a very different mindset to, say, a sportsman. Sportsmen are far more regimented. They need to be. That's the demand of their job. Actors are the kind of people that are on 24/7. You can make a shoot 4 or 5 days in a row and we'll keep doing it because that's what we need to do. So we have no concept of time. It can be midnight. We'd be like, no, we're ready to come and shoot. Sportsmen can't do that. So I think it's detrimental in running a team. Over there, you have to learn how to manage, whereas actors, you're busy being managed yourself. So, that doesn't really translate there.
So investing in sports, is it passion that you see or potential or a balance?
Passion. Yeah.
Okay. So now we'll come to the other part, apart from sports. You had an investment in Ziddu, right? That was a very interesting one. And what did it teach you about the timing of investment? Because I believe you exited from that at a very handsome returns, right?
Yeah, I can't complain, yeah.
Okay. So what about that? What was the idea behind that?
I don't think timing has anything to do with it. I think you have to decide when you're willing to get off the bandwagon, or when you've had enough, or this is all I can contribute. To be very honest and blunt, I think we got very lucky with Ziddu. In tech, I think, as I'm sure you all are far more qualified than I am, but there's a huge quotient of luck that's involved in any sort of startup. And I think we got lucky with that. So the one thing it taught me is that there's no rules in investing. You just have to be a bit instinctual.
But what I've seen and found it very interesting is Ziddu is a tech company, then Vadam, the tea brand, and Nagin, the hot sauce.
Yeah.
And now Swiggy. Of course, we'll talk about Swiggy later. But what was the idea? I mean, it's like very different segments. So is there any central theme to it? Or how do you think that, okay, this is what I want to invest?
I'm glad you asked that, because I get asked this very often. And what's really exciting me currently is the whole India story. That really excites me. And for me, as an investor or even as an actor, there has to be some personal resonance in whatever I do. Otherwise, I get very bored. I'm not the kind of investor who says, okay, I've got some, disposable income here, let me put it here. I can't. I need it to be interesting to me. I need there to be a personal story to it. So currently, the whole India story is really exciting me. I was sent to Europe to study when I was 9 years old. So I had a very Western upbringing. So my view on India was from out in. And now that I work here and I've obviously been here since I finished college, to get a world view from within India is very interesting to me. And to see that today we're very unapologetic about what we do. We're market leaders in whatever we do, and it's wonderful. And there's a great sense of pride. And I'm enjoying that story. I like the fact that something as basic as 20 years ago, if you wanted to go get something which was cutting edge and in fashion, you had to go abroad. Today, you get it here. I like the fact that today we are competitive and comparable to any of the top brands across sectors. So that excites me. You spoke about Nagin. It's very simple. I chanced upon the sauce. I really liked it. And, I reached out to them and said, hey, guys, I'd love to work with you and help you. And that's how it started. Thankfully, in my household, we like spicy food. So everybody, uses it. So I like to invest in stuff that I use. That excites me. I'm not somebody who can keep an arm's length from my investments. I like to, try to be a strategic partner more than anything else, I like to reach people and say, okay, here's an opportunity. This is what I feel I can do for you. I'm not very good at just standing there and waving hands and, using any sort of, brand ambassador kind of role or just showing up.
Not the angel investor, but a strategic partner.
I prefer that, yes. Because I want to see it grow, because I like it. Similar with Vadam, I saw it somewhere and I just loved the packaging. And the packaging drew me to it, and I said, hey, this is called Vadam, that's an Indian name. And I'm like, oh my God, it's an Indian brand. And we reached out to them, and me and my team, and we took it from there. So these things excite me, and I really think we're very proud about what we do today in India. And that makes me feel great.
That's very interesting. So after the instinct or the India story, what is it that you're most drawn to? Is it founder's vision? Is it scalability?
No, I think the one thing you learn initially when I first started investing is it was just, I like this idea, and then you burn your fingers a few times. And I think those are very important to learn from. But then obviously scalability is a huge quotient to it. Today, with the kind of experience, you realize that, is this a business that can grow? And how big can you make it? What is the potential of the market, et cetera, et cetera. So scalability obviously is now a huge priority, but I still believe it needs to start with genuine love for what it is and the passion for it.
So if somebody comes to you with a pitch, what is it that you look for, and what are the red flags?
The first thing I look for is who's making the pitch. As actors, we're trained in body language. So I prefer to read the person who's making the pitch, because that's going to be the engine of the product. I've received several pitches where the ideas are very good, but just the people involved might not have what it takes or be willing to go the distance. So for me, I like to read the people behind the brand first.
That's interesting. So coming to your investment philosophy, what does value mean to you, both as an investor and a storyteller?
Well, initially it was, is it a source of happiness for me? Then you realize that happiness is also a very expensive thing. So you then start realizing that, is this going to make me some money as well? So you don't want to be, I mean, nobody's here to do charity at the end of the day. It sounds very nice to say all these things, but everybody's here also to make money, and you can't be losing money. So obviously, value comes in. Are you going to get a return for your investment? Plus, coupled with that, is it a product you can be proud of? I'm immensely proud of all the products that I'm invested in. And like right now, I was just speaking to my friend Akash over here, and we were just discussing, we do a lot of our investment work together. And like say, you know, I invested in Swiggy some time ago. And I did it because, it sounds a bit funny, but I really like misal pav, all right? And my favorite misal pav is Mamledar Misal in Thane. Who was that? Who hooted just now? Well done. Yeah. So, and my breakfast is Mamledar Misal from Thane. But obviously, you know, shooting the way we do, which is daily, getting Mamledar Misal from Thane is a bit impractical. And suddenly I discovered it on Swiggy. And I'm like, wow, I got to be a part of this. So, you know, we reached out, and I actually put it out on Instagram. I was so excited. And they got in touch, and we, you know, invested and took it from there. And I just love the fact that some of your favorite foods, you can just literally press a button and it'll be in your house within half an hour, 40 minutes. Similarly with Zepto. I mean, these kids weren't even born when I started working. I don't like saying that, but it's true. And today, just look at the wonderful work that they do. It's amazing. It's amazing. They've become like, you know, these beacons for the world to say, hey, age is not a construct and we can do this. It's amazing. Press a button in 10 minutes. Even if you need ice, if you're at dinner at home and you've got some friends over, you run out of ice, you press a button and it's there. It's fantastic. And this is all being done here. You know, we don't need to have that complex of, oh, it's bahar ho raha hai. No, it's happening over here. And Indians are making this happen. I love that.
That's very interesting. I mean, when you think about it, getting a printout to getting a toothbrush, toothpaste, or anything, now even an iPhone, and Skoda trying to deliver a car in 10 minutes, right? That's funny, right?
Yeah, that should be fun to watch that happen, yeah.
Right. So coming to, you know, as an actor, as an investor, what is more rewarding to you? Seeing a great script succeed or seeing investment soar?
Wrong forum to say it, but for me, it's still a great script. I mean, I'm an actor at heart, and that's my first love. So, a great script coming to life. You know, when you read a script and then you dream about how it'll be, and once it comes out and it's exactly what you want it to be, and then hopefully the audience likes it. There's no better feeling.
Once an actor
Earning a lot of money off a great investment also is a close second. Is a close second, but this is incomparable.
But sapne, what was the dialogue? Sapne dekho,
sapne mat dekho, sapne kabhi sach nahi hote. Mera bapu kehta tha. Lekin maine sapna dekha.
Right. So, but over the years, has your approach to risk changed from first investment to next, or first film to next?
Well, luckily in film, you have to be a risk taker, right? You have to try and maintain an edge. You have to tell a newer story. There's a very famous saying that, give or take, there are only about 9 stories in the world. They're just told in different ways.
The 9 rasa.
Yeah. And so you have to try and find a newer way to say it. we were discussing this backstage with, the advent of satellite television and now OTT platforms. I think what has happened is suddenly our audience, which was traditionally only going to a big single-screen theater to watch a movie, now has world cinema at the press of a button. So not only has their attention span reduced, so if they don't like what they're watching, they press pause, they're gone, but they're getting to see stuff which come from different nations, different cultures, different societies, different storytelling. You're competing with them now. You can't just be about, oh, this is just an India story. You're competing with the world. When that's the case, you have to keep thinking of what new can I do? How can I attract them to come watch my product and then keep them there and interest them? And so in films, you're continuously trying to do that. I think investments are slightly different. You can't have, just that approach.
And do you see your generation of actors are approaching at money and finance differently than the previous era? Because the previous generation was mostly real estate mein dal do, right? But now there are avenues as well as opportunities. You also invest a lot in real estate, but are there more opportunities now, and you and your generation looking at these diversified kind of investments more?
Evidently. I think that's a factor of time. For example, when my father's generation and all were there, they were so busy working because that was their only source of income. I think today actors are willing to make films their main source of income, but not their only source of income. That's what I've tried, because that gives me the freedom and liberty to make the kind of films that I want to make and tell the stories that I want to take, which may sound a bit of a risk if that was the only thing. So I can afford to price it more competitively because I don't have the pressure, thankfully, today, of running my house based on just my films. I've spread that across all my other stuff as well. So, and there's that much more knowledge, there's that much more information available to you that you can go out and invest. So I think the younger generations are a bit more cognizant of all of this and are trying the level. It varies from person to person. It's an individual choice. I have a lot of colleagues who want to have nothing to do with investments. They just want to do their movies and that's it. There are other people who are interested in it. There are certain friends of mine who are first businessmen and then they're actors. So it varies from person to person, but I do see there are a lot more opportunities today.
No, but do you see this as a legacy building also? Or
Absolutely, absolutely. That's something that really drives me. For me, it's always been also about, can you make a difference and can you leave behind a lasting impact? That drives a lot of my decisions, be it in my films or in any of the businesses that I take on. It's about creating something. Can you be a differentiator and can you leave behind some sort of an impact?
And what has shaped your perspective more? Is it a failure or a success?
Success will never ever teach you anything. Failure will teach you everything. And we should stop looking at failure as a bad thing. I think it's inevitable. It's also very important because success is only built on failure, not the other way around. And like I always say, success is great, makes you feel great, but failure is what's really going to teach you. Yeah.
And do you have any role model in investing, maybe here in India or outside?
No. No.
True. And do you see a future where you launch your own fund or studio incubator?
No. That's too much stress. Like I told you, being a team owner is very stressful. This will be even more stressful. Yeah. With the average age of these new young kids, oh my God, they'll drive you crazy. No, I'd much rather just invest in them and help them grow if I can, and jump onto their bandwagon. I'm not like we're actors, right? So essentially, I'm used to being told what to do and how to do it, and then I give an input of maybe we can try it like this, and this will help improve it. I don't think I have that ability in me. But never say never. You never know.
Never say never.
Yeah.
But I like the clarity that you have. So if you had to give one piece of advice to the next generation, to creators or athletes on managing money, what would it be?
have a long-term view, especially to sports people. I've been involved in sports for now 12 to 13 years. I've seen some wonderfully talented people run their course and then have a very hard time because they haven't managed to plan. They're going to be good days, and guaranteed they're going to be bad days. So prepare for those bad days. Be invested carefully. Make sure your money is earning money for yourself. Don't just spend all of it. I mean, I'm not very big on saving in that sense, but I still believe that if you earn money, then make sure that money is also earning something, even if it's just lying in the bank. So, you know, be invested so that you're covered and you're taking care of your future generations.
And as I can see, the time is up, so I will ask the last question. What is your comment on today's film business scenario? Because we are seeing a time when a lot of films are failing on box office. A lot of films are not releasing, like 250 odd films are ready, but they are not getting a release window. And Hindi film industry seems like going through a time where everyone is trying to understand what is happening with the viewers.
ये सवाल मुझे बिल्कुल समझ में नहीं आता है. This question has been asked for the last 50 years. We're still around. We're still the largest film industry in the world. We still shell out almost 1,000 films a year. How? Why? Nobody's really been able to successfully answer that. If everybody knew what makes a successful film, all the films would be hits. But you're talking about a commercial art. It's a very tight rope you have to walk. Nobody has the answer to that. Nobody goes out saying, "Chalo, aaj acha de rahe hain, aaj flop film banate hain." They don't do that. You're out there to make a successful film, and it's a business. Sometimes you succeed, sometimes you don't. The problem is you're dealing with an art form which is going to be judged by a third person who's not invested at all, even emotionally, in what you're doing. And they judge what you have to do. Why are films not releasing? Films have always been made and have waited for the right time to release. That backlog has always been there. I don't think the Indian film industry, or if we're narrowing it down even further, the Hindi film industry is going through some major problem. This is an issue we've always had. You have to see, audiences' tastes change, and they change every Friday. The only difference is today they're a lot more impatient. They're not willing to accept something on a regular basis that they've seen before. They want to see your effort. They want to see you do something different. What new am I going to learn? I feel the younger generation is, they're more interested in the experience of watching a film. So is the story something that can take me on a ride? Is the experience of going to the movie hall with my friends and family, is that something that I'm going to enjoy? Don't waste my time. Give me an experience. So I think these are things that always change, but these are no new questions. These are questions that have always been around. It sounds very nice to say we're going through this really tough period. You're dealing with the film industry, which shockingly has historically had an average success rate of between 2 to 8%. But the Indian film industry has been around over 100 years. It's just something that we love. We love our movies, and we're going to continue watching them. We can't be complacent about it. You still have to try. But like I said, it's a commercial art. So you're always walking that tightrope between the business of it and the art of it.
Basically, if we are worthy of your time to asking the consumer. But great, on that note, thank you. Thank you very much for spending time with us.
Thank you.
And please, a great round of applause.
Thank you.
Check. Mr. Bachchan, thank you so much for talking to us straight from the heart. And Gaurav, thank you for asking some of the most pertinent questions on behalf of all of us. Ladies and gentlemen, you know the drill. Come on. Well, the real deal begins now. Please join us as we all raise a glass, share a thought, make a brand new connection. Day 2 at the Mint India Investment Summit begins tomorrow at 9:30 a.m. sharp. Please take a look at the agenda and be in your seats on time. I'm Zina Fernandez signing off for today. Thank you and good night.